I don't want to say it's not a catastrophic miscalculation, but it's a dangerous cocktail, what's been happening. Tax receipts are going to be falling. You're going from a higher debt level, get a much weaker dollar, and that creates a real inflation bounce out of that problem. Now is the time when you want to start buying some of the smaller names versus the larger names, or you want to start looking at the tertiary metals versus the big metals.
All right, Larry. Oh, and first of all, can I call you Larry? Is that fine?
Of course, yeah, yeah.
Good. Well, thank you. Well, first of all, thank you for being here. Thank you for letting me call you Larry. And this is Real Money Talks, though. It's a weekly gold and silver kind of mega episode that we publish. So I want to know what your highest conviction play is right now in the metals. I want to know what you're making of gold at an all-time high right now at this juncture. I want to know what you're doing with your money. Maybe push you a little bit on silver because I haven't heard you talk too much about it. And I want to know what institutional investors, or at least the ones you're talking to, are investing in right now. Maybe drop a word on, I know uranium, kind of controversial when we're talking about gold and silver, but still, and hopefully a couple of other gems as typically present in your interviews. And then for people listening right after Larry, I'm talking to two Explorcos. One of it is Altamira, which they have a potentially significant copper gold porphyry discovery in Brazil. And the other one is BlackRock Silver with about 100 million ounces of silver in Nevada, potentially more. That's what they're looking for. Timestamps are on your screen right now. They're in the description of the video and on the time bar. So use them or don't. It's your life after all. But Larry, back to you. I appreciate your time. So in an effort not to lose too much of it, what is your biggest conviction plea for the rest of 2024 and into 2025, and why?
At this point, the thing about the commodity market is certain things get priced in faster than others. I think some of the natural gas names are still left behind. So there's still a lot of love there. And I think that would be a high conviction like Intero AR equity. They bought back 11% of the stock. They're producing tons of cash. I think it's like 10 to 12% free cash flow yield. And if you believe in the AI sales pitch, we're going to need a lot more natural gas. And so artificial intelligence, all the stresses across these data centers, all these data centers being built, natural gas names like Antero are, high conviction ideas for us. The other is Alcoa, where copper is so stressed, aluminum, data centers, once again, power grid. The street has spent the last year downgrading Alcoa. When Alcoa hit the lows in the first, second quarter, the street's sell recommendations peaked. And that's always a good sign. Whenever the street, with cyclicals especially, whenever the street starts to really downgrade these stocks, and when the downgrades spike, that's typically, especially if it's year end with tax law selling, that's a great time to get into some of these names. Also, with Alcoa, you benefit from this multi-trillion dollar, well, I should at least $1 trillion China stimulus plan, and so you have you got a dual factor there. You've got the upside of China and that stimulus, and then you have the upside of the U.S. power grid rebuild. And so yeah, those are two areas where we're really focused right now.
I was kind of hoping you'd say, "Oh, my highest conviction is gold because it's going to go to 10,000," and I was going to put that in the YouTube title, get a bunch of views. But every time someone brings up gold when I ask them about their highest conviction, which is very typical right now, I get that a lot. I'm kind of reminded of people like Rick Roll who've always told me to be a contrarian or be a victim. You either choose one or the other. And so I know you've taken a very contrarian approach since I started following you, and probably long before that. What do you think about gold here? I mean, can you really be a contrarian and be bullish on gold at the same time right now, given how popular it's gotten?
Well, I want to say something at the outset, like you're not really listening to Larry McDonald, right? It's like I am blessed I wrote the book and we have a Bloomberg chat behind us. So we work with hedge funds, mutual funds, and pension funds in 20 plus countries. So what we're doing with the bear traps reports, we're democratizing information. How do we get these high conviction ideas? Is we run them through the conversation behind me with people that are in different parts, like emerging market investors on the buy side, which is hedge funds, mutual funds, and pension funds. Also currency investors, metals and mining investors. And so the one high conviction trade, I can see a trend shift that when we saw this with uranium in 2020, 21, you can see more people caring about certain things. And when smart money is like we can detect when the smart money is coming into a trade. One trade right now is Palladium, because of this whole rollout of electric vehicles versus hybrids. And I think the gold versus palladium and platinum is pretty silly. It's pretty crazy priced. Gold's like the mothership. So the beginning of a commodity bull market, everybody's hiding out in the mothership, and everybody's still afraid of the tertiary metals. That's where the opportunity is. Gold is like all the gold ever mined in the history of humanity would fill up an Olympic swimming pool, but all the palladium ever mined and all the platinum ever mined would only go up to your ankles in that same pool. So they're so much rarer than gold, and you do have this potential on demand coming on dramatically from the rollout of the not just the rollout, but you got to look at where EVs were supposed to be by now and the market share that hybrids are taking away from EVs. And
Oh, for
hybrids
sure.
have your catalytic converters, platinum and palladium.
Oh, for sure. I've been enjoying your takes on EVs and AI over on Twitter. People should follow you on Twitter. I'll put your Twitter profile right on screen right now. It's yeah, a lot of good stuff on there. What happens though to the hard assets market, if you want to call it that, Larry? If there really is that $1 trillion shift, as you like calling it, I mean, if that money actually starts coming into those, because you mentioned it's not a lot of gold, there's not a lot of platinum, there's not a lot of palladium. I mean, most of these markets have been beaten down to a pulp, right? And I'm not even sure they can take that much liquidity. So what happens in that case?
Yeah, and so exactly. So when the Fed says higher for longer for a year and a half, um, it keeps the dollar up, and it scares it. A lot of the hot money just doesn't want to be in the tertiary commodities, the metals, the small metals, and it's just when you have a central bank that's really going higher for longer, threatening more rate hikes, that's a lot of all that speculative money gets drained out. And now that the Fed has, we've got interest per day of $3 billion, right? We've got interests on the debt annually, 1.1 trillion. So I think the market's starting to figure out higher for longer is complete bullshit. And, it's not your 1990s Fed. It's not your 2010 Fed. Higher for longer is complete and utter bullshit. You can't, if you keep interest rates here, interest on the debt a year from now is going to be like $1.4 trillion. It's going to overwhelm the budget. And so that's why when you look at the smaller metals, and you think about, you get back to your point. We saw this in 2022. There was 20 trillion in the NASDAQ 100, 20 trillion. Inflation stayed higher. The Fed was not tightening aggressively back then. And so the NASDAQ 100 went from 20 trillion to about 12. And to your point, it doesn't take much. Now, not all that money went into commodities, right? But it doesn't take much because the entire commodity sector is so, like you said, so small, the metals, that even $4 or $5 trillion coming out of growth stocks and going into value and to commodities makes a huge difference. And so that's what happened in 2022, and that's already starting to happen again. That's what's happening now. Yeah, so right now there's about 23 trillion in the NASDAQ 100. So we went from 20 trillion in 2021 to 12, 20 trillion. This is the NASDAQ 100, 20 trillion to 12 to 23. And that money we're already starting to see a shift into gold and silver, into all kinds of metals, into emerging markets. And so, yeah, so that, like to your point, it just doesn't take that much capital to come out because these markets have been left for dead. The last point is with the oil sector, So in 2014, 10 years ago today, the oil sector was about $4 trillion. And the NASDAQ 100 was just about 4 trillion. They were about the same size. So that's energy sector and the NASDAQ 100, both close to 4 trillion. Today, the NASDAQ 100 is, like I said, up at 23 trillion. And gold, I'm sorry, oil and gas is still down at 20, I'm sorry, a little bit less than 3 trillion. So you've got from 4 trillion each of oil and gas versus the NASDAQ 100, around 4 trillion each 10 years ago. Today, you're up at 23 trillion for the NASDAQ 100. The entire oil and gas space is down at 3 trillion. So you've gone so the NASDAQ 100 is almost 20 trillion greater in value than the oil and gas space today relative to 10 years ago. And like you said, it just doesn't take much. If 1 or 2 or 3 trillion dollars comes out of oil and gas, out of the NASDAQ 100 goes into oil and gas stocks, it's just going to make a large difference in valuations.
You made an interesting point there, saying that we're already seeing that shift into gold and silver. Where are you seeing? Is that, like you pointed to the screens behind you? Are the people you work with and the people who get the bear traps report, are they telling you that? Are they asking about, hey, I want exposure to precious metals, how do I get it? Are you seeing a lot of that?
Well, this year, I mean, the GDX is outperforming the NASDAQ by a lot. But last time we looked, about almost 7 or 8 or 9%. So there's money moving into the GDX. There's a lot of money that's come into silver and gold. You talk to people like Adrian Day and gold funds, they're starting to see some assets come in, inflows, and you're seeing money go from growth to value. You're seeing money. Just look at the last couple of weeks. BHP, you look at Alcoa. These stocks are 20 to 30% off the lows, and so these are companies. Freeport McMoran is like 20, 25 to 30% off the September lows. So that's in the copper space. So you're seeing a lot of inflows of capital into hard asset companies the last month.
Yeah. Yeah, I talk to Adrian Day sometimes, although I'm still yet to receive a non-uberly bearish view on gold from a uberly bullish view on gold from him. So, but you brought up a good point about the Fed and the cut that they did. I want to talk about that later on as well. Maybe they're panicking, maybe they're not. But in your recent book, it's called How to Listen When Markets Speak. I'll put that on the screen as well for people to see. You emphasize listening to the signals that the markets are giving you, among which the Fed. And so what are those signals for gold? And more specifically, what indicators are you turning most to in order to take a decision to say, like, okay, now is the time to move to hard assets?
Well, yeah, thank you. Yeah, how to listen when markets speak.
Oh, there it is.
And it's been a top seller on Amazon. It's done well, and I'm really proud of the team because we had an incredible team that put this book together. Neil Ferguson helped me. Dave, we sit down with David Einhorn, legendary hedge fund investor David Einhorn, legendary hedge fund investor David Tepper, sat down with Charlie Munger in Omaha. Charlie just passed away, but we sat down with Charlie. And the one thing I'm hearing from the professionals the last 2, 3 weeks, 5 weeks is, and this is going to have a huge impact over the next year on commodities and hard assets. We're talking about, this is, I don't want to say it's not a catastrophic miscalculation, but it's a dangerous cocktail, what's been happening. And it's every investor listening to us right now needs to wake up. So the Democrats were kind of behind the polls, and obviously Trump won the first debate. The consumer confidence was at Lehman levels this year, 3 or 4 times. Lehman levels, consumer confidence. So the Democrats, the Congressional Budget Office told us that the deficit this year would be 1.6 trillion. Now they're admitting it's going to be 2 trillion. So 1.6 to 2. So the Democrats have wisely but dangerously juiced spending by an extra $400 billion, right? At the same time, Powell, I don't know if it's either political reasons or it's the interest on the debt, which we've gotten into, because the economy you got Mark Zandi telling the world this morning, this is the strongest economy he's ever seen. This is Mark Zandi, like he's an economist, well known, highly respected by the White House. He's telling you it's the strongest economy that he's ever seen. And meanwhile, the Fed is opening the door up to 50 basis points, another 50 basis point. They just cut 50. So you've got the $400 billion of extra, so $2 trillion of fiscal overdosing there. You're overdosing on rate cuts in a strong economy, according to Mark Zandi. And then you've got China. The Fed wasn't expecting this. You get China doing $1 trillion of fiscal and monetary.
Right.
So this cocktail together is what gets you that inflation bounce, that big move from just like 2022, where inflation bounced and you had trillions of dollars move from hard asset, from growth stocks over toward hard assets. That's what that cocktail, that conversation is what I'm hearing from the professional investors behind us this the last month or so.
Would you say the Fed panicked? I mean, I said I want to talk about that, and I think I've heard you reference that before. But did they panic and overdo it again? Because it wouldn't be the first time they're doing it either.
Well, there's a whole bunch of things going on. If you look at the regional banks and the way they were performing, you look at U.S. Bancorp, which is the fifth largest bank in the country. The way these banks were performing from 2023 to 24 was really sick. Like there's a clear interest rate risk on the balance sheets with all this commercial real estate. And then there's tons of consumer risk. Listen to the CFO of Ally Financial, right? You just look at the performance of Capital One versus American Express. You look at Discover. There's a clear trend toward higher defaults. And so you had this huge problem with the consumer and inflation around higher rates that was crushing the consumer. At the same time, you had this problem on commercial real estate, which we had the banking crisis in 2023. The Fed knows that there's trillions of dollars of bonds that still are on the bank balance sheets that are going to reset. So yeah, there's no question that they need to get interest rates down to avoid a blow up in the commercial real estate market. They also need to get interest rates down to, help the smaller, consumer, the consumer that can't make those car payments. And so even though the price for that will be inflation. So that's the cocktail that they're kind of dancing with. And yeah, they definitely are under, and then like you said, interest on the debt. If they keep the Fed funds rate here, because what Janet Yellen has done is not it's not an evil thing, but it's very dangerous, disgusting. But by putting that many treasury bills on the front end, like there's an enormous amount of paper that the treasury that's going to have to roll over, and it's all sitting in T-bills. And so if the Fed doesn't get rates down fast, we're talking about it's 24 and 25, we're talking about $15 trillion. Like that right within say 24, 25, and a little bit of 26, it's like half the US debt is rolling over. And so they got to get those rates down because the average weighted coupon on the debt is like right 2.4, 2.5%. And so if they keep interest rates higher for longer and the front ends up here, all that a good chunk of that 14, 15 trillion all of a sudden resets to 4 or 5%. And then your interest costs are going to go up even higher. You're going to go from 1.1 trillion to 1.5 to 1.6. So that's part of the mystery in this cocktail where Yellen wanted to win the election. She, instead of issuing lots of longer dated bonds, she issued everything in the front end of the curve. It was a dangerous move, smart politically if you want to win the election, but then you're setting up a huge problem for 2025 and 26.
Well, but to your point of listening to market signals, it sounds to me like those are no market whispers anymore. It's more like the market screaming at the crowd. But it also seems like everyone's kind of plugging their ears and not really trying to hear it. Because you look at some of these things like Nvidia, what is it up 150, maybe 200% on a 52-week basis? Why does Why does the crowd not want to listen to the market? And what's going to make the crowd actually start listening to the market?
Well, NVIDIA is just this CapEx explosion in the valley. So if you're a CFO in the valley, you're Mark Zuckerberg's CFO, or you're working at Microsoft in the financial in the team. You have to basically go all in on this capital expenditure because it's like a scene from The Sopranos. But they all have a gun pointing at each other because whoever wins, whoever doesn't win is going to be out in the cold. And so that a lot of the beneficiary of that's been NVIDIA. And then there's a whole other thesis around, oh, AI creates so much productivity that it creates this kind of magical growth path for the market, which is it's maybe true. We know the productivity is going to explode, but that's going to be over a long, long period of time. And so what happens with markets, and we saw this in '99, a lot of these things will go up on euphoria and down on impatience. Amazon's the perfect example. Everything about the Amazon bull case that was written in 1999, just about everything, but it's true. But the market went up on euphoria, and it took Amazon a long time to kind of fill into those shoes and that dream. And so the stock literally went up on euphoria, down on impatience, and then it took 10 years to get that valuation back. And so that's what's probably going to happen with a lot of these AI plays.
Up on euphoria, down on impatience, maybe down on reality with most of these AI things out there, which is kind of interesting too. But what do you think? What I really ask you back there, Larry, was what do you think the most important signal is overall going forward? Like, is it rate cuts? Is it earnings? Is it the jobs market? Is it what do you think is the thing that everyone should listen to when it comes down to listening to the market?
Okay, the most important signal. Um, it's going to be the dollar around, like, if the China fiscal is this big and this large, what happens with the dollar is there's always two or three drivers, but one of the biggest driver is the rest of the world. So if the rest of the world's doing better because of this is almost like a 2008 or 2009-10 stimulus package coming from China. And so that's going to support the global economy. And there's $75 trillion of GDP outside the United States. There's a lot of economic activity. And so if the global economy is starting to strengthen a little bit, at the same time the US economy is weakening, that gets you a real super crazy move in the dollar. And so so if the dollar is already the rate of change in the dollar versus emerging market currencies is already pretty crazy. One thing, Jens Nordvig has been our partner for years, and he watches the rate of change in those tertiary currencies. Not everybody it's a little in the weeds, but the bottom line is if the dollar really breaks down, that's when you know that this great migration trade is really going to start to accelerate.
Improving global economy and worsening kind of domestic economy in the US. That's an interesting situation because going back to your book here, and I'm not even paid to promote it, maybe we should discuss that. But a lot of the book focuses on past crises like the Lehman Brothers that you've mentioned and others that came before. But what period of those crises periods do you think is the best parallel to the situation that we have today?
Well, one of the things we talk about in the book is the fiscal monetary response to Lehman, the fiscal and monetary response to this is the great financial crisis, was $4 trillion. The fiscal and monetary response to COVID plus the regional bank crisis of last year, and now this latest, we got to win the election, is $16 trillion. So think about that. The fiscal and monetary response, that's like the emergency capital to come in and save the day. That was $4 trillion under Lehman. But since with COVID, the banking crisis, and then now, okay, we got to win the election, it's 16 trillion bucks. And so for the love of God, this is blood curdling. What in God's name is next? If you're going from 4 trillion to 16, and then something happens, a 9/11 or something happens and they have to respond again. I mean, that is a real terrifying thing, because you're talking about going maybe to 20 trillion. The other thing that we're hearing from all kinds of institutional investors behind us is, if the US economy is slowing a little bit with this 16 trillion of fiscal and monetary, what happens if Kamala Harris wins the election and she doesn't take the Senate? Then there'll be some sour grapes on the Republican side. They'll force some austerity in there, right? And so that's where that kind of forced austerity, you get into what we call a fiscal cliff. Because if you go from spending 2 trillion this year to like 1.5 or 1.4 next year, because of some like austerity that the Republicans try to enforce onto Kamala Harris, that gets you a big slowdown. Tax receipts start to come down, and that gets you a real pretty nasty stagflationary, like a 1973 to 1980 type world. And that's where, remember, when you got to 1980 or 81, industrials, which is, industrials, metals and mining, materials, and oil and gas, those groups were 49% of the S&P 500's composition. 49%. Industrials, materials, oil and gas, and just those groups: industrials, materials, and oil and gas, and throw in the metals. 49% of the S&P 500 composition. And we're talking within the last year, that number has been down to 12%. So you go from 49 of hard asset type companies to 12. In the book, How to Listen When Markets Speak, we don't think we're going back to 49, but are we going back to 30 from 12? Yes, we are. Yes, we are.
And it goes back to, I suppose, to what Lynn Alden's been saying, who, by the way, is also commented on your book. I think she also likes it, but fiscal dominance, right? Nothing stops this train. Therefore, it always goes back to, again, hard assets. So gold and silver and other, as you mentioned, platinum, palladium, should see a response there. Is that where this is going that you're telling me here?
Well, yeah, what happens is, if the Fed's forced, when you have that $35 trillion debt hole, the only way out of it is a default, what we call a debt jubilee. We went back in the book to many different civilizations. There are many debt jubilees where people just walk away. The other ways out is financial repression, and that's where you keep interest rates below the rate of inflation, and that's how you can kind of burn your way out of it. The problem is that creates a weaker dollar. And if there's, like I said, if there's any kind of softening of the economy in the next year or so, and then you've got that weaker dollar because they've got to kind of inflate our way out of this, that's what drives money into the hard assets. I mean, you look at the moves in palladium. You've had 800, 900% moves over the last, I'm talking like going back the last like 20, 30 years, like 40 years. So you've had moves of 800% in things like palladium. You've had moves of 500% in palladium. Same thing with platinum. So hard at like the bottom line is, it goes back to what you said about liquidity. The gold's a $16 trillion market, right? 16 or 17 trillion. It's incredibly liquid. Silver's about $1.5 trillion market. Platinum and palladium combined are just, a couple $100 billion. So it doesn't take much. It takes literally a fingernail to come out of gold and go into these other metals. And these metals can be up, 300-400%. But you do need, the China thing is really important, because the fiscal side of China, is really helpful to the hard assets as well. Whereas if China was going into a deflationary spiral, that would be good for the dollar, and that would really hurt the whole hard asset trade. But remember, we've had 2 years of those fears, right? We've had Evergrande 3 years ago. We had the China property crisis. We had the lockdowns. So we've had like 3 years of these China growth fears. I mean, just every single day. So that's been driving money out of hard assets and commodities. And now we've got this $1 trillion bazooka coming from China on the heels of 50 basis points from the Fed on the heels of another 2 trillion of fiscal in Washington. And that to me is, there's no certainty in life, but the probability of this, the great story in this book, How to Listen When Markets Speak, the probability of this thesis really playing out over the next 18 months has gone up a lot over the last 3 months.
The only certainty in life is that when I buy something, it's going to go down. So maybe I should let people know when I buy gold so that they know that's a regional top. But how long do you think that thing is going to take to be reflected in the market? I mean, how long do you think this migration from financial assets to hard assets it's going to take before it starts becoming more prominent in the market, if you will?
Well, we've had, like I said, let's go back. We had this really take off in 2022. So that's like the appetizer. It's 2022, there was a big migration. So it definitely, the whole process kicked off there. And now inflation, remember, if inflation normalizes at 2.5, 3.5 to 4, that is what really triggers this whole move into hard assets, into value stocks. Because what we talked about in the book is if there's certainty of deflation, your net present value of all future cash flows in companies is worth more. In other words, if deflation is certain, then historically people want to own growth stocks. Your net present value of all future cash flows. You look at what we call as a DCF model. Growth stocks are worth a lot more in a certain deflation world. But if all of a sudden, if there's more certainty around inflation because of the massive China stimulus, because of all the rate cuts, because of the weaker dollar, if inflation is more certain, then the net present value of all future cash flows in these companies is worth less. Because think about it, say, I'll keep it simple. So you have a company, you're going to get $1 billion in cash over 10 years, right? If inflation is certain, that $1 billion is worth less, right? If a company like Alcoa or Antero or BHP, they own tons and tons of copper that's in the ground. They own tons and tons of aluminum that's in the ground. And so when you have that elevated inflation world where there's a more certain path of inflation, capital will migrate dramatically from the large growth stocks. Your Microsofts of the world are going to lose trillions of dollars in valuation with that more certain inflation path. And that money will move into the BHPs, it'll move into the Rios, it'll move into these big, your Chevrons, it'll move into these large cap companies that own assets that are in the ground.
How long will the age of hard assets continue on for? I mean, is this going to be the age of hard assets, or is it just going to be a blip and then we go back to, buying non-profitable tech companies again?
Well, once again, that the non-profitable tech companies, they did the best in that 2020 to 2021 world, where if you talk to anybody, if you were on Twitter, if you're anybody in the media, people would laugh at anybody talking about inflation. It was a just joke. So that's where that net present value of all future cash flows, those profitless companies were worth so much more in that world. But now, because of what we've done since COVID, like I said, that you've gone from the $4 trillion response to Lehman to a $16 trillion response since COVID, adding those three things together, the regional banking crisis, COVID, plus this election push, that just gets you a lot more certainty around inflation being more sustained, having a bounce here. And then on top of that, you throw in the China. So the probability of inflation bouncing and that moving money from growth stocks to value to hard assets, the probability of that is high. And the timing of it, to me, looks like that would this trend, to your point, like how long would this last? Looks like it would last at least 5 years, this migration, this time around. The last migration, remember, this is like a good conversation. So the last migration lasted a year and a half, right? So 2020, 21, we had this big move in inflation. 22, it was about a year and a quarter, year and a half, where you had this big move from growth stocks, profit less companies over to hard assets, over to value, right? And that, but since then, we had a Fed that says higher for longer, promising higher for longer, all bullshit. Once the Fed starts to admit that that's not the case, now we have the China fiscal side. All of that gets you this next run to hard assets, I think lasts at least 5 years. The biggest threat is a deflationary spiral, but I just think the probability of sustained bounce in inflation in the last couple of months, it's gone from here to here. In other words, in the last 6 months, like I said, we did an extra 400 billion of fiscal. We got a 50 basis point rate hike. We got some more, I'm sorry, rate cut. We got some more cuts coming, and we get a surprise $1 trillion package from China. All that means that this is probably going to be a nice 5-year run for hard assets, financialized value stocks.
What was interesting to me during that last run that you're describing, I was paying attention to it very closely, was the type of companies that did well. And within the resource space, the companies that did best were not the ones making money. It was a lot of the explorers and the developers. So what do you think happens this time around? Is the rotation only going to be true for the companies that are making money, like your Newmont and Barricks? Or are we also going to see, again, the unprofitable, the explorers and developers? Are we also going to see them appreciate, or are we
Yes.
even going to see them appreciate more like they typically do?
Yeah, so you get into a very important point, and this is when a commodity cycle comes in, people first hide into the mothership, the commodity, gold. Or in 2020, everybody went into oil first as we came out of that risk, out of COVID. Everybody went to oil, then they went into Chevron and Exxon. Next thing you know, they're going into Marathon, Oxy, and all the other tertiary names in the oil space. There's thousands of them, hundreds of them, hundreds and hundreds of them. But to your point is the money doesn't go in to the speculative side until the market can see a mature, sustained movement toward higher inflation, a real sustained move. The market needs to see a real sustained, a real believable path that the Fed's on an easing trajectory. You just need that. You need that real sustainability. One area that's been left for dead are these rare earth metals. The REMX is the ETF, and we have a capitulation model in our Bloomberg. We run it through our own software and our own technology around the capitulation model, and we look at the drawdowns looking back in these stocks, and you look at the China stimulus. That's a potential big positive for what we call rare earth metals. And then if you look at the Trump administration or either Trump or Kamala Harris, they know that there's a national security issue around rare earths. And so the probability that you get a big move here in some of these junior miners into uranium or just the rare earths, that's a speculative space, but a nice way to own a basket of those is through an ETF. So you're not owning one company, but the REMX has been destroyed, left for dead, bombed out village. And that's the type of asset that will do well. To your point, you bring up a great point. Like if this next move goes on for 5 years, then within the first year, all of a sudden, capital will go into the GDXJ, the SILJ, the junior uranium miners, or things like the REMX, which is the kind of the smaller companies in the rare earth space.
That's a wonderful point, especially when you bring up timing, because how long do you expect that it's going to take within, in that 5-year cycle? How long do you expect the more speculative equities are going to need to start moving or start getting some tailwinds at least?
Well, you're starting to see in the last week with this China stimulus is really, the RMX has moved a lot. So a lot of the juniors in some of the metal space have moved, and so, but yeah, it's a process that it takes at least a year for, and you're seeing this already with the GDXJ though, right? So we track the GDXJ versus, so the junior gold miners versus the gold miners. That's been literally breaking out of a multi-year downtrend. So we're starting to see it in some parts, but we haven't seen it in other parts of the junior space.
And when you say you're not seeing it in other parts of the junior space, what I'm thinking about specifically is the most speculative of the bunch, sort of the micro caps that need to, as soon as possible, no longer be micro caps because otherwise it's a dilution nightmare. Right. And so what I'm really asking here is when's the right moment to actually start paying attention to this? Because they can have explosive gains when you get the timing right. But if you get the timing wrong, you get diluted into oblivion. And then you no longer really have an ownership of the company as much as did, and so on and so forth. So when's that right time going to be?
That's tough. The microcap, I just it's very. I think it is about time, because of this move in China with the Fed easing, everything coming together. But when capital really, I'm talking to the micro caps, when that really takes off is hard to judge. But the one thing about smaller caps is that when you meet like billionaire investors or wealthy people that have kind of mastered some of these areas, the one thing is if you buy 10 smaller cap companies, and you're careful, you have some good advice, you're working with a professional, but if you buy 10 of them, if six of them go to zero, but four of them go up like 400 to 1,000%, even one or two of them goes up 2,000%. You're actually still making money. But the key is you just can't put concentrated wealth into small microcap companies. It's like you said, it's too hard to detect. You want to watch them, right? And you want to watch the flows. You want to watch the SILJ versus the SIL, the junior silver miners versus the silver. And you want to see a long-term trend get broken. That would be a good leading indicator for the rest of the small cap space too. And that's why you want to watch the GDXJ versus the GDX, or you
Mm.
want to watch the URNM versus the URNJ.
Mm. And you're
As in
looking
the
for,
uranium space.
yeah, exactly. And you're looking for a breakout where the URNG in that last example starts outperforming the URNM then.
Yes. Or we were looking at like next gen versus Cameco. Um, if in the early stage of the uranium market, the performance of Cameco versus all the other juniors or the smaller caps was just incredible. And it's the same story when you talk to professional investors around the world. A lot of these people can only own the large cap company, and it's like it's not really fair, right? Because at the early stage, just not enough money in the space, and all the real money accounts, the big pension funds, the mutual funds, the big what we call real money accounts, all those guys and gals can buy are the big cap stocks. But when the bull market matures and more speculative money comes in, the hot money, then those types of investors can own the smaller caps. And so that's why we tracked with uranium for years. We've tracked the relationship between NextGen and Cameco, and things like that. And there have been periods where NextGen, started to break up versus Cameco. And so, or just look at like I said, the URNJ versus URNM, or you could just look at the URNM versus Cameco itself. That's probably another good way
Yeah.
because that would be an indication that everything's more broad. The URNM versus Cameco. I should take a look at that. Right? I haven't looked at it in about a couple of weeks, but that's something that if the URNM starts to dramatically outperform Cameco on a week by week, month by month basis, then you know that things are maturing out.
It might mean that there's more generalist investors coming into the space, kind of dipping their toes in the water too. Although Cameco is a big part of the URNM specifically, so that could be, that could be something interesting to look at. What about like if we go into a debt spiral though, or hyperinflation, or all the very scary clickbaity words that people would typically use? What in that situation, you basically don't want anything to do with any type of risk on assets, right? Or do you think this time could be different because of that shift into hard assets and commodities?
Well, if the event is systemic like a Lehman, then correlation goes to one. So we talked about in our first book. Our first book is a New York Times bestseller about the financial crisis. And all the commodities, correlation went to one, and everything got hammered. Then the Fed comes in, eases, This time around, when the Fed comes in in that kind of a situation, then tax receipts are going to be falling. You're going from a higher debt level, get a much weaker dollar, and that creates a real inflation bounce out of that problem. But that's if it's a systemic event. If it's if it's if it's if it's that's remember that's like a Lehman thing with the big bank going down. If it's what we call a supernova economic boom, and that's what we looks like we're in now. We're in an economic boom that what happens with an economic boom that we're with inflation involved and higher rates, the first victims are the lower middle class, and the poor, and that's really sad, because they don't have much savings. The smallest difference hurts these families. It's really tragic what's happening. And this is going to require a lot more federal assistance too. Now, it's like the supernova burns off, it goes up where inflation starts hurting the middle class. Then it starts hurting the upper middle class. Look today, like there's some concern in there. So the luxury car company, I think Aston Martin, stock down a lot today. There's some of these luxury names, the Lulus of the world, have really started to like give way. Well, these things were like the hideouts, very safe places over the last year and a half. So this is what we're looking at. It's more like a supernova burnout where inflation actually causes a recession because it goes from lower class, middle class to upper middle class, and it starts hurting more consumers all the way up the channel. And the Fed can't, if the Fed doesn't get rates down fast enough to help stimulate, people right now, people can't even make car payments according to the Alley Financial. So in that kind of world, it's pretty good for hard assets. I don't think it creates like it's pretty good for small. I mean, listen, small caps are always more high beta. So if the market's down 20%, small caps are going to be down more. That's high beta. If the market's up 20%, small caps and the high beta stocks are going to be up more. But for the most part, in that kind of like hyperinflation world, or that kind of like that's a good situation for hard assets and hard assets companies. You just have to keep some powder dry and make sure that you're benefiting from that volatility, and you're ready to buy things when they're 10, 20, 30% off.
Hmm. Yeah, you saying that small caps are always high beta is true, but also kind of disappointing because I was just really looking for a justification to show my wife and be like, honey, serious analysts just told me that small caps will do well even in an event of a crash. But you're right, it's not realistic to believe that's actually going to be the case. So
they'll do great over time, but yeah, you're going to have some vol in there, and that's why you just have to you have to keep that powder dry. And, there's an old scene with George Costanza in Seinfeld when George was struggling with dating for decades. And, he said, everything that I do is wrong. Because there's a video, just if you Google the YouTube Seinfeld Costanza scene, and it's called The Opposite. And so what George starts to do is, if he says if everything I've ever done is wrong, then the opposite would be right. That's what Jerry tells him. And George starts to try to do the opposite. And all of a sudden, he's having tremendous successes because he's doing the absolute opposite of what he would do. It's the same thing with markets and volatility. When I was younger and I was trading, it was really hard because I would always wanted to buy breakouts. I would chase momentum, and you end up in a high beta area and you're getting whipped around like that. You end up taking your stop loss, taking your time. Everybody and all the bullshit technical analysts on Twitter. There's some really good ones, but there's so many BS artists, and they just make it sound like, oh, you just get stopped out. It's no big deal. What happens in these if anybody that's using technical analysis in these high beta areas is just getting chopped and stopped over and over and over again, destroyed. You're much better off with a high beta sector like uranium is to buying into do the opposite, buy into the most feared moments and lightning into strength. It's the opposite of what everybody does on Twitter in the technical world, right? You really want to buy capitulation sell-offs in high beta areas and lighten into strength and then be there for the turn, because that's the way bull markets are formed. That just look at Cameco, look at even any of the small caps in the uranium space. These things got destroyed with many high beta, like horrific drawdowns, and that's what you want to be in there. You want to be buying those really horrific drawdowns, and you want to have some powder dry. You don't want to be just getting stopped out over and over again.
That is an excellent point, and I wish I'd listened to this 3 years ago. But fortunately, I didn't. I do share your view on most of the TA out there, though. But how would you? Yeah, so we're talking about different metals, different hard assets. If you always mentioned platinum, palladium, gold, silver, sort of precious. You mentioned rare earths. You mentioned uranium a couple of times. Do you have like a mental list for yourself where you say, okay, I'm really most bullish on this, and the list goes down, and does that reflect the way you've built your portfolio now? Like, what's the portfolio breakdown, if you will?
Well, it was like a year ago, we were more bullish on gold than silver because gold is benefiting from what we call central banks globally. And like I said, gold's at $16 trillion market. So on the early stage of the bull market, we're looking at the big pools. And same thing with the early stage of the bull market, we're looking at the large cap gold miners, right? The Agnicos. Look at the performance of Agnico versus the juniors. It's been spectacular. It's like it's way outside the historical norms. And so, yeah, what we're looking to do now, and then that's the way we put our hat on and say, okay, right now we're much more bullish on silver than we are gold. We're much more bullish on palladium than we are gold. That was not the case a year ago. You talk to any one of our clients. And so it's the same thing on the energy space. So right now, a lot of people are hiding out in Exxon, right? You look at Exxon versus the XOP, look at the ratio. Uh, there's a big fear of the energy stocks right now relative to say two years ago. A lot of the money was going into the speculative names. Right now, you can buy Occidental Petroleum below where Buffett's been buying it over the last year. Buffett has 260 million shares. The last 100 million shares were bought, above where it is today. So I think now is the time when you want to start buying some of the smaller names versus the larger names, or you want to start looking at the tertiary metals versus the big metals. And that all depends on where you are in the cycle. Like if you're at the end of the hiking cycle, like I said, the one thing that can kill you in junior miners or silver or smaller metals, tertiary names, is the Fed going higher for longer, keeping that dollar up. If they're promising all kinds of rate hikes and they're keeping the dollar up, that's like, why do you want to be owned? T-bill pays 5%. If T-bills are paying 5%, risk-free, and inflation's like coming down because the dollar's strong, money just goes into T-bills. But as the Fed starts to cut, and now you get the China stimulus, next thing you know, T-bills are coming down, and you get a bounce in inflation. All of a sudden, cash is a less attractive place. That's what creates the move where some of the smaller names should start to outperform again, as long as we don't go into a really, really, really hard landing, because that would take down a lot of the smaller caps too. But yeah, I think we're at least now, because if you just look at all the inflation fears for the last 18 months, right? Jamie Dimon 18 months ago was talking about hurricanes. So if you just look at the market, there are some parts of the market like the Occidentals that are already pricing in recession. So you can start to go into these things. Even look at Schlumberger. I think you can buy Schlumberger almost on the 200-week moving average. I mean, that's a pretty good deal. And so would I buy Rig now over Schlumberger? No, that's maybe a little bit too small, but I'd be thinking about it like within the next 9 months. Yeah, Rig has more debt. It's more speculative. Schlumberger is the bigger cap name. So yeah, but I want to start looking at some of the smaller cap names that have better balance sheets. The ones that have too much debt, I'd be a little bit careful right now.
So as long as it goes back to when I ask you what's the most important indicator, you kind of said the dollar. That's what you want to look at, the strength of the dollar. The strength of the dollar has not necessarily been determined over the recent past, it seems to me, by the dollar itself, but mostly it's kind of been the cleanest shirt in the laundry basket type of thing, right? Because other other nations, or when I say the dollar, I'm really talking about the DXY, so on the euro and so on. So what, even if we don't get higher for longer from the Fed, what if we get other nations like the ECB cutting rates much quicker than the Fed? And even if the Fed cuts two more times, it does a double cut of 50 basis points, but the ECB cuts way more than that. Is that still going to influence the smaller cap names the way it has over the last 2 years?
Yeah, so there's two things with the dollar. One is the Fed direction. When the Fed's in a high conviction move in one way, if the Fed's being wishy-washy or hawkish, that's going to keep the dollar strength. But if the Fed's in a more high conviction move lower in rates, that's going to be really bearish for the dollar. That's going to be good. The second point is to what you're getting at there is the dirty shirt. If China wasn't doing this $1 trillion plan, and Europe is in a lot of some pain, like Germany slowing down, and you've got some issues with the budgets in both Italy and in France. If that, and you had the war the last 2 years. Once again, you've had the war over there the last 2 years. So my point is, if you come out of the war, you get this big, huge China stimulus, which we're getting. That the biggest beneficiary of the China stimulus is Europe, and so that's why that's so important. Most likely, what happens here is that the China stimulus supports Europe to some extent. You come out of the war, a lot of this around the ECB being more aggressive than the Fed. The Fed funds rates higher than any rates in the world. So the Fed has a lot of catching up to do on the way down. And yeah, so your point is correct. Like if the ECB has to be more hawkish than the Fed, that's one thing. If the ECB has to cut more than the Fed, then you're going to have that dollar going to be stronger. And so, but I just think the China stimulus thing news, which is big news, that's going to support Europe, and it's going to more support that 70 trillion, 75 trillion of GDP that's outside the United States gets supported there. And that gets you the double whammy, where the dollar is a victim of the rest of the world having some cleaner shirts, and the dollar is also a victim of the Fed being on a more certain cutting path at the same time. So that's where you get the dual tailwinds for the bearish dollar, right? And that's the best case scenario. That gets you moving the dollar from, say, from the 90s to the 80s, maybe even the high 70s. And so, but you need both of those tailwinds working at the same time. And that's what would get you that spectacular move into hard assets.
And I hope that happens. And I really hope you're right. My portfolio does. And so does my wife, by the way, Larry. But talking about my wife, she's asked me to find a new series for us to watch. You mentioned Seinfeld and The Sopranos. We've watched both of those. What else should we watch? What else do you like?
The series, it's, I think that, I mean, it depends. Are you talking about Netflix or
whatever? We're kind of migratory in that regard. So if there's anything to watch someplace else, we'd cancel for a month.
Netflix, The Queen's Gambit is fantastic, and
Yep.
it gets into like the whole psychology of chess and global competition. It's pretty inspirational in some ways, but it also has a dark side to it.
We started, we never finished it, but this is motivation to go and finish it. Queen's Gambit. We should do that. I'll write it down. Thank you so much for sitting down with me today, Larry. What am I forgetting to ask you? What else did you come here hoping to talk about that I'm failing to bring up?
Well, just that, what we're trying to do is democratize information. And so bear trap support, we're working with the most successful investors in the world. And when I started off on the retail side of the business, and I was on Cape Cod in the 90s, and you just felt like completely bamboozled by Wall Street, even as a financial advisor, because by the time you get the research as a financial advisor, a lot of times it's been multiply picked over, right? And when I went to Lehman Brothers and worked on the institutional side, I saw that firsthand, where the best research ideas would go to the proprietary trading desk, then to the institutional clients, and then it would eventually go to the retail brokers, right? So what we're doing with the Bear Traps report we're really trying to democratize things where you can get our report. It's not a newsletter. It's not. It's more of a lens on what the big professionals are doing, right? It's my dream in life. Imagine sitting by the pond or the lake in upstate New York or Vermont and just writing a newsletter like that. We don't do that. We have to run this conversation with 10 people and host hundreds of people on this platform and kind of like, okay, go through and find out what trends are we seeing from the institutional side. Are there more people coming into copper names? Are there more people coming into uranium names? And when you can see those shifts, that's how you can start to listen when markets speak. But thanks. I appreciate it.
That's an inspirational Twitter quotes for, maybe I should start a Twitter page and call it quotes for bag holders or something like that. It is inspirational. And so I do wish you luck with the sales of that book, by the looks of it. And I haven't gone through it all, but by the looks of it, it's a wonderful thing to read. So thank you, Larry, for letting me call you Larry, first of all, but also for being here and for the added value. I'll let you drop off now, though, as it's I'm going to have to keep moving it on here. It is thebearstrapreport.com for people who want to read more from Larry. In the meantime, I'll be moving on to one of my favorite parts of each Real Money Talks episode, each episode really that we publish. And that is, of course, the disclaimer, right after which I will actually jump over to the CEO barbecue portion. But there is a warning on your screen right now. So first of all, I'm obligated to put it up there, but also you're obligated to read it. But outside of that, I would still do it if I weren't obligated, and you should still read it if you weren't obligated, because this is not just some random disclaimer of, oh, this is not financial advice, although it is also that, but it is mostly an actual warning that will help you not lose money, which, by the way, is the norm and should be the expectation in the exploration and development sectors. When it comes down to mineral exploration development, of course. And that's part of it too, by the way. When you talk about money, I'm here to make some. I make money from the existence of this channel, and specifically from companies paying for the production of these interviews. Now, in this episode specifically, none of the two companies that you're going to see have paid to be here. Those are free interviews. They are either companies I've met at conferences or companies that people have requested for me to interview. And I'm not being compensated to produce or publish these interviews. But that does not mean you should look at this episode any different, because even the companies that are not paying, they're still likely seeing their participation in this program as a chance to do some marketing. So start by understanding that. Start also by understanding, or continue by understanding, that most company communications online, albeit this interview or their presentation or their Twitter accounts, their beautifully made websites, their presences, is that a word? Their presence at conferences, whatever else it might be, that's all marketing. And although I don't make buy or sell recommendation, because I think there's a clear conflict of interest given the nature of my business, many out there will do. Many out there will take money from the company and still make a recommendation that you should buy their stock because it's the next best thing. And you should be aware of that. It doesn't mean it's always garbage, but it does mean that there's an inherent bias to those business models. That bias is unfortunately not always going to be clearly disclosed. Sometimes it's again not easy to spot, not with everyone out there. So it's safer for you, anytime you're watching any type of company specific content, just approach it with a dose of skepticism and treat it as marketing. Unfortunately, I'm not a magician. The guests are not psychics. And some of the CEOs can sometimes even be normal people. So we don't possess any superior knowledge about what will go up, what's going to go down, or what's going to go in circles. We don't know. We don't know what's going to happen, even if some of us might want to believe that they do. Also, unfortunately, try as I may, I won't catch all red flags or all challenges with the companies or all shenanigans or whatever else it might be. And although you should never tell my wife this, I'm not flawless. Matter of fact, I still have no idea what I'm doing, and try as I may, Again, I still haven't learned it. I still haven't made it. I'm still here, right? So I lack the experience. And this is actually all to say that you shouldn't blindly trust me or anybody on the internet, and you should do your own research. And as Charlie Munger used to say, if you don't understand it, don't do it. In addition, there are no guarantees that are going to be made here besides one, and that is that there will be forward-looking statements in these conversations. Those are conversations that are general and impersonal in nature, containing hopes for future events that may or may not take place, depending on many different factors, both within and outside of the company's control. Be aware of that. Be aware of the inherent risk to investing and the increased risk of investing in non-revenue generating companies. And please talk to someone who's proven to know what they're doing and talking about, like a professional investment advisor. Not that they're always going to be right, but that's what you're supposed to do. You got to obey the rules, I suppose. But also just really for yourself, do more research before taking any decisions. Just looking at the presentation or watching a couple of interviews is not enough research. You're going to lose money if you do that. You go to setterplus.ca, that's a government official website where you'll find the company's official filings. You download the MD&A, that's the management discussion and analysis. You download the financial statements and the management information circular, by the very least, after you've looked at everything on the website, all the news releases and the presentation, and you've spoken to management. You look at these three findings, at least. If you know a bit about the rocks, you also look at the technical disclosures, of course. If you don't do that, you are highly likely to lose your money. This is not easy at all. There are disclaimers on your screen right now. If you don't enjoy losing money, read them and be careful out there. With all that said, though, I'm going to shut up now. Well, not quite. I'll just kick off the CEO barbecue portion of this Real Money Talks episode. Not actually shutting up, though, because I'm going to be traveling to Brazil once again. Who's, by the way, Brazil is the world's largest producer of coffee. But instead of doing coffee tastings, unfortunately, or maybe I shouldn't say unfortunately, but I'm going to be looking for gold and silver in the northern part of the state of Mato Grosso, which is located in west central Brazil. I won't be going there alone, though, as I'll be joined by Mike Bennett, the CEO of Altamira Gold Corp, a gold exploration company listed as ALTA. So that's ALTA on the TSX Ventures Exchange in Canada, where an average of about 60,000 shares trade each day. And I see a 52-week high of almost 19 cents and a 52-week low of about 9 cents. There are 212 million shares outstanding, and with today's $22 million market cap, that means ALTA is trading about 10 cents per share. In addition to the 212 million shares outstanding, there's 47.5 million warrants and 16.2 million options, leaving the number of fully diluted shares at almost 276 million. A famous name on the share registry here that you might recognize is Crescat Capital, owning close to 16% of the company, and Mike here owns about 5% of the company himself, to my own estimations, as he owns about 10 million shares, or just a little over 10 million shares, actually. The last officially financial statement on setterplus.ca, which shows me the numbers as of May 31st, 2024, has over $3.2 million in current assets on it, most of which, $3.1 million to be specific, was at the time in cash and cash equivalent, with, of course, some prepaid expenses and some receivables on top of that as well. Total liabilities sat at just about $350,000. All of which was current liabilities, meaning no long-term debt, and all of which basically made up by account payables and accrued liabilities. In terms of operating expenses, the 3 months or the 3-month period that ended on May 31st this year costed Altamira about $270,000, which is an average G&A cost of about $90,000 per month. The largest element of that spent was consulting fees and staff costs, which together with professional fees represented about 51% of the total administrative spend for the company. About 28% of the spend is represented by advertising and promotion, and the remaining 20 or so percent is represented by travel costs, office in general, and a few other smaller expenses. As to exploration and evaluation costs, Altamira capitalizes theirs, so to find them, you're going to have to scroll to note 4 in the financial statements to see those. And they show almost $1 million or $1 million spent for the months of essentially March, April, and May of this year, which is an average cost of about $316,000 per month. Drilling itself, though, accounted for over half of that spent, so that's 54% to be specific. 21% was spent on geological work and about 16% on the camp, with various smaller expenses making up the rest. So in summary, 90 grand a month went into administrative costs and almost 320 went into the ground, leaving us with an exploration to administration ratio of about 3.5 to 1, meaning about 78% of the money went to exploration and evaluation, and a rough 22% went into administration. As always, though, please understand that this financial statement is nothing more than a snapshot in time. In this case, it is specifically at the end of May of this year, and it simply shows you what the finances looked like on that exact date and nothing more. Finances, though, as I like saying, are a fluid thing, so they will change, and math can be hard if you're me, so I could be making mistakes in my reading of them. Be aware of that, and it's just imperative for you that by the time you're watching this, you visit the company's website as well as setterplus.ca to look at the most up-to-date numbers yourself and make sure you're getting the full picture. For Altamira, that full picture is fully focused on Brazil. As I mentioned, they have 6 projects covering about 160,000 hectares of land in the state of Mato Grosso. So all of the projects are in the same state, which is again in central Brazil. Those projects are somewhat similar because of their location on the Alta Floresta belt, which is a historically producing belt where a lot of placer mining, if you will, happened, and also where Anglo-American recently made their Jaca, the copper porphyry discovery, which of course pushed several other large mining companies to seek the establishment of what I would call a decent foothold in this belt. Cajueiro seems to be the current focus for Altamira, though. This was one of the placer camps in the region, historically producing about a quarter or so of a million ounces in the 80s and in some of the 90s as well. But more importantly, it has a resource on it right now, dating back to 2019 and showing both oxide and sulfide mineralization with respectively 25,000 ounces of indicated oxide gold and 160,000 ounces of indicated sulfide gold, whereas the inferred category houses 60,000 ounces of inferred oxide gold and 456,000 ounces of sulfide gold, counted up together between the resource categories and mineralization types to about 700,000 ounces at about 1.2 grams per ton, an average gold grade, with of course the majority being in sulfides. Altamira tried leaching those ounces, and the gravity to leach test gave it varying degrees of recovery between 94 and 96%, so very decent recoveries. Although saprolite is also involved in the oxide part of the deposit, so hopefully I can get a question or two in about that later on. Of course, the sub 1 million ounce, the gold deposit is not the only thing that attracted Altamira to the region, but with the deposit open at depth and along strike, the company believes they can find a lot more gold. Part of that belief is based on an aeromagnetic survey that shows potential intrusive centers. Essentially, if you're looking at a map right now, the purple thingies on that map that suggest that's where the source of the mineralization might be, especially considering that the geophysical anomalies occur below felsic volcanic rocks as well as intrusives that had already been mapped prior to the survey. But there hasn't been all that much modern drilling in this region. So Altamira has some more work to get to before they can define what, if anything, this thing really is. But that will also be part of my conversation with Mike later on. Maria Bonita, which was not included in the Cajueiro resource, is one of the most interesting targets on this project, where recent diamond core assays came back highlighted by 146 meters of 1 gram gold, 50 meters of 1.4 grams, 55 meters of 0.7 grams of gold. That was 55 meters of 1 gram and then 53 meters of 0.7 grams of gold, which the company had multiple field experts, including Dr. Richard Silito, visit the project and have a guess at what it is after this, to which all of them pretty much said, yep, this very well could be a porphyry. The even more interesting part of this, of course, is that copper porphyries rarely occur in isolation. They typically occur in clusters. Altamira's hope here is that the 4 stages of porphyritic intrusion and associated alteration, as well as veining and breccia development that were observed in the last round of drilling, are suggesting they are in the right neighborhood for that clustering to be discovered, which is also why that's also the company's consensus right now, but it's also why they've hired some consultants out of the UK, as well as some more consultants out of Canada to kind of double check their work, if you will, and tell them if this thing really is a porphyry, and if it is, where they're better off drilling. Because 1,000 experts are, of course, no measure for the truth machine. So essentially, it is drilling that will have to prove or disprove the copper porphyry thesis. And the idea here is to drill deeper at Maria Bonita, as well as the other porphyry target that Dick came up with, Dr. Silito. So that, of course, remains to be seen and will be discussed later on. And too much really to be said about the Cajueiro project as a whole, but nobody feels like listening to my voice for another 30 minutes. So instead, I'll have Mike explaining it more in depth later on, and I'll just quickly brush up on the other two projects. Santa Helena, which is Altamira's project to the southeast of Cajueiro. It's about 60 kilometers away from that Anglo-American discovery that I told you about earlier. And some surface work told Altamira that there was porphyry-style alteration there, and a few grab samples also told them that there's elevated gold and copper on surface. So they drilled it and came up with rather narrow intercepts of high-grade gold, including 0.8 meters, so essentially 80 centimeters of 45 grams, and 0.9 meters, so essentially 90 centimeters of 10 grams. A recent ground magnetic survey here has also highlighted the potential for multiple copper porphyry targets related to the 4 areas of anomalous copper in soil that the company has identified to date. But again, this is early stage, so caution is, of course, advisable. And also more work has to happen here. The last of the bigger project is called Apiacus. This one is to the east of Cajueiro, rather close to it too, by the way. And this used to be a significant source of the plastered gold operations that I told you about earlier. The focus for this project so far has been on the Mutum target, where trenching and drilling identified low-grade disseminated gold over a rather large 2-kilometer trend with wide intervals of anomalous gold found in the initial drilling, suggesting, again, that the potential for bulk tonnage coming from 3 identified centers to date. Those are the 3 main projects in the Altamira portfolio, but as I told you, they actually have a total of 6 projects. They are smaller land packages on the same Alta Floresta belt, kind of in between Cajueiro and Santa Helena, if you will. But as far as I understand it, the company does not intend on working those projects anytime soon, and potentially they'd like to JV them, or maybe even use them as vehicles to finance work at some of the other projects, which is something I hope to learn more about later on in the conversation. But for us to get into the conversation, I will have to start thinking about shutting up. And Mike, with all that said, I'll relieve your ears from having to listen to me any longer, and I'll jump into the CEO barbecue with the first kind of obligatory question, if you will, being, who are you and why should I trust you with my money?
Hello, Antonio. Well, great to see you again. And who am I? Well, I was born in Britain. I'm a mining geologist by training from the Royal School of Mines in London. And in 1983, I made my first steps towards South America. So I came to Bolivia. I worked in Bolivia for the British Geological Survey for 2 years before stepping out into the private world to a private mining company. And I discovered the first gold deposit in the east of Bolivia called Puquio North. And that led to me getting my feet wet with both juniors and majors in the 90s. So I worked with Barrick, with RTZ, with Goldfields of South Africa, and with several small juniors before Bre-X came along and changed my career slightly. So Bre-X obviously changed the whole world of the mining business. And it changed my life as well because it turned me into a politician for 7 years. I became the first foreign mayor elected in Bolivia. And then for 4 years became the president of the Municipal Association of the whole country, which was a very, very good step in terms of understanding local idiosyncrasy, understanding how to negotiate, and obviously understanding how to leap through the different loops that occur in this part of the world. And then after that, I decided that 7 years in politics was enough. I then moved back into the business. And in 2006, I first visited Brazil, looked at 2 properties. One was called Coringa, which I started drilling in 2007 and is now a Cerabi mine in production, a gold mine in production in the state of Pará. And the second project was Cajueiro. And why did I like Cajueiro? I think you've touched on it, Antonio, in your summary there. I liked it because the Alta Floresta belt had produced 10 million ounces of gold in around about 25 years.
Mhm.
That gold was largely alluvial and colluvial, so no primary sources had really been identified, or very few. And in Cajueiro, I could see 15 kilometers of east-west extension whereby all of the streams had been worked for alluvial gold. And that really lit up my imagination. And I thought, wow, either, it's all been eroded away, and so there is no prize to be found here, or else there are several primary targets in there which could turn this into a gold project or even a gold district. And so I then have been working along those lines with juniors in Brazil. In 2014, we were given the opportunity by a private company to buy Cajueiro. We did that with a group of friends. We put our own money into the operation. We formed a private company called ALTA Gold, which is still now the holding company of Altamira Gold. And we formed the company. We took it down the road, and that is part of our story. We were early movers where other people didn't really believe in this area. And so we were able to bring 3 projects into our project package. And as a result of that, we have 160,000 hectares now when we kick off as a public company in 2017.
That is quite the career there, and I'd love to touch upon. You call it Cajueiro. Is that you just being British, or is that how you're supposed to pronounce it? Because I call it Cajueiro.
Cajueiro, yeah.
Okay, because it is okay. Well, that makes sense because I tried pronouncing it maybe a little bit Spanishy, and it should be Portuguese, I suppose. So, the presentation says that you have over 10 million shares yourself. How did you get those shares? I mean, did you buy them in the open market and private placements, or did you get them as founders' shares?
I got nothing as founders' shares, Antonio. They're all purchase shares up to the price of $1 a share. So I've put my money where my mouth is. I've kept this company as I have been able to along the years in different private placements, and obviously, the initial tranche as the private company, Alta Gold.
Is this what I'm asking here? And that's good that you're telling me like that, Mike. But is it what I'm trying to figure out here is how important is this investment to you? Like if something goes awry, are you sleeping on the couch or are you sleeping on the front porch?
I'm one of these guys who my adrenaline is to find mines. So right from 1986, when I first discovered Puccio North, I realized that I had a good sense of looking for properties with potential and with upside. And so when I decided to do this in 2013, I really did believe that we were going to find something, perhaps not what we've considered to what we found over the last 2 years, but I really believe we were going to get an upside on the Cajueiro property. And so, what we try and do is we try and show people that there's something where other people have perhaps not considered that we should turn the rock over. And we believe that we have here a very, very large gold district in Cajueiro now.
There is a 2.5% royalty, I believe, on Cajueiro. Is that who owns it? Is that you or any of the team members personally, or who's that royalty for?
No, there are several royalties. There's one on the very central portion, which is owned by the landowner, 2.5%. And then there's another couple of royalties over the whole of the exploration package. One is owned by the private company that we bought Cajueiro from with 1.75%. And then there's a 1% owner who goes back to original times of 2006, I think it was.
Okay. None of that is like Mike Bennett personally to your name.
None of it's associated with me or any of my family or anything.
Good. That's how I like seeing it. Good. That's part of my smell test before we actually get into the real barbecue. Let's talk about how you're planning on making yourself and shareholders money here, which is through increasing share prices, of course. And that's mostly you want to get that through exploration upside, as far as I understand it. And I want to talk about all that later on. And the land you're looking for that exploration upside on has already been looked at by the locals, but never by modern exploration companies like yourself, as far as I understand it. Why not? What stopped them from looking over all these years?
I think it's a window of opportunity, Antonio. If you think about, what the area looked like in the 1980s, first of all, it was nearly all jungle. There were thousands and thousands of garimperos, these local miners roaming around. And so in the 80s, it was a deterrent to any mining company to come in there and try and, rub shoulders with these guys. What's happened in the last 40 years is absolutely eye-opening, First of all, the infrastructure has just blossomed in the area. So there are asphalt roads everywhere, power lines everywhere, hydroelectric schemes everywhere, internet works everywhere. In our Cajueiro property, we have internet in the camp, we have grid electricity, and it takes me from where I usually live in Alta Floresta 1.5 hours to drive there. So it's a second to none project in terms of infrastructure. In terms of why no drilling was done there, well, perhaps you've got to look at, the 80s and 90s were, period when these local miners were there. Then Briex came along. It perhaps probably created our exploration world for 5 or 6 years. And so in 2003, 4, perhaps things started opening up again. And when did we, when did I first see Cajueiro? It was 2006. So it was first drilled in 2007. There were no drill holes in the property before then.
That's also maybe a good point. You actually live in Brazil. So that's one of the other things that I should have mentioned there. The interesting background and knowing the history there definitely helps. So kind of the local miners almost acted as safeguards for the region, and they kind of kept it for you up until 2007. But let's talk about the future here too, though. When Dr. Richard Silito visited the project, the conclusion was that there could be a cluster of porphyries there, which to me sounds like anything but simple exploration. So what's the plan? What's the strategy to come up with and test enough targets to prove or disprove that thesis with the drill bit on some kind of a reasonable budget?
Yeah, okay. Well, so first of all, you made the comment that we're in the center of Brazil. We're not just in the center of Brazil, we're in the center of the continent. And that's a really important point here, because the rocks are 1.8 billion years old. And normally you wouldn't expect a porphyry rock to have been preserved for that length of time. So obviously the center of the continent's been very, very stable for a huge amount of time. And the fact that, in 2017, Anglo-American discovered the first porphyry copper in the belt, Jaca, kind of opened people's eyes to the thought that, there might be copper in other places. But what we've discovered now is that there's also gold associated with these porphyries. So if we just go straight away to Maria Bonita is 7 kilometers away within our project area. So the project area is 23,000 hectares. It is something like, in its furthest extent there, east-west, it's about 20 kilometers. So it's a very large belt. It's a district. And Maria Bonita occurs 7 kilometers to the west of our central resource area. Now, we first put a soil line over this, Antonio, in 2018, and it came up with gold in more or less all of the soil samples we did over that first line. I'll be quite honest and tell you exactly, and the viewers, what I did with that. I stuck it in a drawer because I believed that was contamination. There were no rocks on surface. I had no idea what was causing it. And I thought, well, there's no way there can be that much gold on surface. So roll it forward to 2020 during the COVID period. We got our guys back in the field again after 4 or 5 months out. We were sitting there and I got a call from my geologist and he said, Mike, what should we do? The machinery hasn't arrived to start doing trenching. Shall I take them out of the field? And I said, no, Elvis. Get the guys to do soil sampling and we'll check that area over Maria Bonita. And lo and behold, all of the other lines came back with gold in. So that showed me that there was obviously something there. The doubting Thomas of this world thought, well, maybe it's a paleo channel off the major river or something like that. And the only thing we were able to do was to drill it. And so in 2022, we put the first holes into Maria Bonita. In a completely virgin discovery, we find the first gold porphyry in the Cachoeira district. So that's a real eye-opener to us. We're right on the top of the system there. It's got these textures in these kind of brain-type quartz veins, which are called UST structures, which is the top of the porphyry system. And as you've rightly said, we've drilled 146 meters of 1 gram of gold in hole 29. But the more important thing about that hole is we've drilled 212 meters. So the entire drill hole has 0.8 grams per ton gold in it, with no high grades in there to make this an unreliable average. So the system is still open at depth. Many of our drill holes are bottom in mineralization. And so you quite rightly pointed out as well that one of the things we will be doing in the near future is doing deeper holes in this system to realize how far down the mineralization does go. But Dick Silito came out there, he said, wow, you found a very interesting porphyry here. It's got nothing else in it apart from gold. So if we think about mining and we think about, you know, gold recovery at the fantastic price of $2,600 an ounce right now. We've got fantastic metallurgy because we've got no copper in it, no nasty elements in there at all. Absolutely incredible recovery. The top 20 meters are in a very soft saprolitic material, which can be taken out easily with a backhoe. And the added benefit to that is we can heap leach that material. So we've got a really, really cheap route to taking out the top or the cream of the cake in Maria Bonita deposit, which almost anybody could do. We could do it, or whoever else could do it, you know? And we've bought the farm there as well. So we're the owners of the farm, we're the owners of the mining concession. We've got a power line running right through the property. We are 1.5 hours away from a population center of 150,000 people. We're in prime mining territory.
I like talking about cakes, but I also think that another point that you made there that I thought was important is that this is the most stable region of the continent. I think that's a very good point, and something I haven't thought about too much. So maybe we should do a separate whole nother interview in the regional geology. There's enough to be said there, I think. But is there, just to go back on some of the technical stuff that you mentioned, is there any overprinting of the quartz veins that you're talking about? Like, are they showing any epithermal overprinting, or are they consistent with that porphyry thesis?
Now, these are stock works within the porphyry. The UST structures show the top of a phase. So what Dick Silito has logged in our system there is 4 phases of the porphyry. And he believes that if we drill deeper, we will get repetitions of these phases of the porphyry. So a couple of things happened as a result of this. One, we are actually building the 3D model of the first 32 holes that we've drilled in the property to date. And with that model, we'll decide whether it's inclined one way or the other. And that will help us to understand how we've got to drill it to see the deeper parts of the system there. And the second thing that has helped us to understand is that, you know, we kind of knew that there could be other porphyries around, but we hadn't really wanted to call it a porphyry, I suppose. So Dick Silito incentivized us to think, well, guys, look, you've got all of these alluvial drainages more or less terminating on an east-west level within your property package. Couldn't there be other porphyries in there? And that's what stimulated us, Antonio, to go out and look much more recently over the last 2.5 months for porphyry number 2, which we've discovered 1.8 kilometers to the east of Maria Bonita. We call it Mumbaki. It's still in its very, very early days. We probably shouldn't even have seen it because it's mainly covered by younger material, but we have seen it. So we've seen the bits and pieces on surface with the quartz veining, the similar type of stockwork that we've been talking about in Maria Bonita. And this is porphyry number 2. I will, as I've mentioned to you, we will show you that in a section. You'll be able to see it in a section. And we're really excited about this because we believe that here we've got an absolute walk-in drill target as well. And better still, if we think about what our second consultant, whose name was Eugenio Espada, said to us, he said, look for porphyry 0. Now, what is porphyry 0? So porphyry 0, if you take take Colombia, for example, the top porphyries on surface, these little stocks, these porphyry stocks, like Maria Bonita, sit there in clusters. And what plumbs the whole system is usually a copper gold porphyry, which is magnetic. And so we have now done, we've got both ground magnetic, drone magnetics, and fixed wing flown magnetics over the whole of our property. We've sent that off, we've had it reinterpreted, and lo and behold, right below Mombaki, at a depth of 500 meters, is a very strong magnetic anomaly. And so we're building that up as a 3D model, and we will have in the next 2 or 3 months a story which we will be able to sit down and design a drill program on, not just Maria Bonita, but also on Mombaki.
And at Maria Bonita, you're coming out with distal porphyry style mineralization, as I mentioned before. But so, is that your thesis? Like the center of the porphyry, if you will, lies at Mombaki. That's the current the current company thesis, if you will.
Not necessarily. I think what we may find is a whole series of these stocks over an east-west trend. If we look at what we've got right now, and if you look at the maps that we've got, from one point to the east to the west, from Novosonius to the west to Sosego to the east, we have something like 10 kilometers of east-west extension there. And I really firmly believe that there will be a series of these porphyry stocks along some trend in that area, which are turning out to be the sources of the alluvial gold, which the artisanal miners took out in the 80s and 90s. And that below that will be the deeper porphyry 0 chamber. Now, whether the center of it is Mombaki, or whether the center of it's further east of that, or whether the center of it's further west of that, we still have to discover.
Are you going to have to do any fluid inclusion studies to know how deep you have to drill it, or how deep do you want to go on it this year?
Well, we have a deal struck a month or a year or so ago with the University of Sao Paulo, and they are doing age dating, fluid inclusion work, etc., etc. And we'll probably send some samples off to other labs as well, Antonio. But yeah, we will need to do that. We'll need to understand where we are in the system with all these different porphyry stocks before we bite the bullet and really drill these deeper holes, you know?
So you don't know how many meters you want to drill in the next pass?
Well, I mean, we just drilled 5,000 meters into Maria Bonita. We'll probably be something like that in Mombaki. Our geologists, as we speak, we just had a call this morning, as we speak, they're moving further east from Mombaki now and looking at the sources of other streams, which we really didn't have an idea what could be the primary source of before. So, you know, I think that as we really start getting our teeth into this, we're going to turn this into a porphyry district.
When it's not seasonal, right? The work that I believe Brazil has a rainy season, but I don't assume it's stopping you from drilling, because I'm trying to kind of figure out the timing of it, or when you want to drill, when we're going to see some news from that.
Yeah, no, it's not seasonal at all. There is a rainy season. The rainy season probably starts in about 2 months' time. It doesn't affect us at all in terms of our area because the infrastructure is so good. What it does affect is the planting of soya. So in the next month or so, a lot of the fields which cover these areas that we need to prospect will be covered in soya. And so if we want to drill in those areas, we obviously have a slightly elevated cost because we have to compensate the farmer for the amount of soya he loses.
Okay, that's interesting. That's something I want to talk about later on too. Um, your communication and your relationship really with the locals. You have talked about this potentially supporting bulk mining, though. Is that still part of the, I want to call it the belief, but is it a goal or is it just an idea? Do you actually want to go for it?
Well, so the bulk sampling technique is where does it come from? You know, the main environmental permit for a project usually comes at the stage where you really know how many ounces in total you have in that project. Because we have an ever-evolving project, there's a process where you can get a bulk sampling license, and that will allow you between 50,000 and 200,000 tons of rock to be processed a year. The idea of that bulk sampling license is twofold. One, to open up an area and to be able to see it, because if you know the area that we're looking at in Cachoeira right now has an absolute maximum of 5% outcrop. Maria Bonita had 0 outcrop. Mombaki probably has 6% outcrop, absolute maximum. So, you know, what we're doing with this is bulk sampling license allows us to open the area up, to map it properly, and to do metallurgical testing and produce gold on that area. We are going through the process of, first of all, we have been given these 4 mining bulk sampling licenses. And what we're doing right now is we're getting the environmental permit for that, which still hasn't been approved, but we are working through that process. So if we want to, in the next year or so, we could certainly move into that regime. But obviously our focus is to show the world that this is a district. It's not a small gold project. It's not a 700,000 ounce resource. It's a much bigger resource. We will internally go through the process of figuring out what our 3D model shows us in Maria Bonita to date, and also program those deeper holes to try and really understand what we could have down to 400 meters depth rather than 200 meters depth.
When you're mentioning that depth, I'm reminded of why I even wanted to ask you this in the first place, but most of the grades are kind of hovering at around 1 grams per ton or so. So how scalable do you think this deposit might be in a bulk mining scenario? Again, from a grade perspective, so cutoff grade, but also strip ratio, recoveries, and what you're actually going to get out of it at the end of the circuit.
Well, I think the benefits of Maria Bonita are that of 5,000 meters of drilling. I haven't done the statistics, but I would very much doubt whether we have 15% of samples with no gold in it of all the 5,000 meters of drilling. So the whole system is mineralized. It is a mineralized system. It has different pulses of the porphyry. Some are higher grade than others, but the entire thing is mineralized, and the only thing in it is gold. So a comment that Quinton Henning from Crescat made when we did the initial tests on Maria Bonita was, he said, "I've never seen such low cyanide consumption in any project that I have ever looked at." So cost, the farm's ours, it's mineralized from surface, the soil's mineralized, the saprolite's mineralized, the rock's mineralized. In order to turn this into a very large open pit is a very, very easy project, because there's nothing standing in the way which would cause us a cost negative here. Everything is cost positive.
Talk to me more about the global idea behind even doing this in the first place. I mean, I understand the idea of wanting to generate cash and lower dilution that way, and then reuse that cash flow for exploration after that. But is it not going to slow you down? Is it not splitting focus? Because you have a chance at a cluster of porphyries here. Wouldn't that get priority over doing literally anything else?
Yeah, I mean, obviously that is, our adrenaline, Antonio, is to find big deposits. That's what we love doing. we usually find them from complete virgin discoveries. And so what we want to do now is we want to build this up. Now, there's nothing to say that if somebody comes along and says to Altamira, we want to be a partner and start working on this sort of thing, we could certainly consider that. We're not going to lose our focus in terms of what we're trying to do here. We're trying to turn this into a big project. If somebody wants to come along and do that bulk sampling testing, and Altamira gets a benefit from that, that's a certain possibility.
Sure. What about timing in that case? Because I suppose with gold where it is right now, when the market potentially heating up from here on, it's going to be timing sensitive too, right? You want to be there with something in your hands to show once the market is there and paying attention. So how are you going to manage that?
Well, we're going to carry on drilling. We will, there are various options in terms of what we have to do, depending on the amount of drills or amount of meters we need to drill. Obviously, we have another partner apart from Crescat, which is Aura Minerals. And Aura Minerals is a mining company, with a very, very strong presence in Brazil. And so, there are things that we could do with Aura or other companies to continue doing the exploration on Cajueiro and our other properties. So, for the time being, we haven't explored those possibilities. We've still got, a couple of million in the kitty. And, the next drilling is certainly something we'd like to do on our own. But let's imagine that, the deeper holes suddenly came up with something which was a lot longer than 146 meters at a gram. I think you could possibly see then, looking at other companies like Lavras, how that's affected their stock price. And I think it would obviously open a lot of people's eyes to what Cajueiro could be in the future.
So you have a couple of $1 million left in kitty. When do you foresee having to raise capital? Is that like something imminent, 3 months, or is it something that you can put off for a couple of months?
We don't have to raise money in the next 3 months. No, in the next year we need to raise money, or we need to look outside the box and find a different way of bringing that money into the company. But we're not imminently looking for money now.
You do have nearly 65 million options and warrants combined. Do you expect any of those to be coming in, or any of those expiring anytime soon?
They won't be coming in right now because they're all out of the money. But they also won't expire. They were generated. Most of those were generated, let me think now, last November. So they've still got another year and a bit to run.
Okay. Yeah. What about the other? Oh no, I have another question before I forget, because I did want to ask you about the saprolite. It's kind of a switching topic because I do want to go to the other projects outside of Cajueiro, but I want to ask you about the saprolite zone at Cajueiro. How confident are you in the heap leach potential there, given the saprolite heterogeneity?
Well, the two tests that we've done on the saprolite from Maria Bonita show absolutely amazingly good results in terms of heap leach. The way I look at it is, why did we buy the farm? And your question going back to NSRs, the way it works in Brazil is that the landowner, it's obviously a negotiated deal with the landowner, but he gets some sort of NSR, some sort of agreement in the gold production. So we just looked at this. We saw made a discovery after 3 or 4 holes, and we bit the bullet and we bought the farm. So we own 409 hectares of the farm there in Maria Bonita. It covers the entire Maria Bonita discovery. And obviously, if we wanted to dig a very large swimming pool of 500 meters by 500 meters by, even 25 meters depth, that is the material that would go on the heap leach, and none of it would have a strip ratio because that's all mineralized.
No, that'd be a party. 500 meters by 500 meters and 25 meters deep. I can starting to get ideas. What about when you start to move into the harder bedrock? I suppose that's for way out in the future, so maybe not necessarily worth talking about right now. But what happens when you start moving into the bedrock?
Well, the bedrock, so we did the heap leach tests on the bedrock as well, but on the size fraction that we put on the heap there, it didn't give us a very good recovery. It gave us about 65%. What we'd need to do for that, we'd need to do further tests. We'd need to do an optimum crush and see what size really the heap gives us a better recovery at, and whether that's economic or not to crush it to that size. But we've also done on that hard rock sample, we've done agitated vat leach tests, and we get plus 90% recovery there. So if at the end of the day we wanted to use that, we'd have to, right now we'd use an agitated leach on the hard rock.
Okay. Are you going to be doing any kind of work among those lines this year, or is it all focused on drilling? Well, when I say this year, I mean this season. So yeah, this next year.
Yeah, it's a very good question. So we've moved back to our central area. We are presently taking bulk sample tests or bulk samples from different parts of our central area, and we're going to do a whole set of tests on those. We've never done heap leach tests on our central area, so we're going to be doing those. And we'll also do other metallurgical tests on that central area.
Okay, so you're going to have some news coming out of that. What are you expecting? One or multiple news releases?
Well, I mean, we've still got news releases to come out on Mombaki. As we're moving across the area, whatever we find in the area, if we find, if we're lucky enough to find another porphyry alongside Mombaki, we'll release that. And we'll have a lot of these things coming out over the next few months.
What do you have at Mombaki? What did you do? You did some soils, I believe.
Soils and rock samples there we've done so far, yeah. And we're putting together a 3D model with the depth slices on the geophysics.
When are you going to have the soils and the chip samples out?
Probably in the next couple of weeks, Antonio.
Okay.
We should have the first press release out.
Okay, so that's going to be the first next press release is soils chip samples on Mombaki. That's going to be very interesting because it's going to dictate the pace forward as well. So chronologically, what comes after that? What's the news release after Mombaki?
Well, after that, we've obviously got to step back a little bit because, once we've got teeth around the central model, then maybe we'll announce that we're going to start drilling again on the deeper holes. We need to kind of ingest this a little bit and just figure out if we can put those holes in. And, what I'd like to do, obviously, is I'd like to drill deeper on Maria Bonita. And if the model shows me that we understand it, then I will announce that to the public.
Does the depth of those holes, by the way, matter in terms of permitting? Can you just go and drill as deep as you want, or do you have to get additional paperwork?
No, you don't need any additional permitting, no.
How does it work in Brazil? I mean, how does permitting work? I know, like in the US, you have BLM and non-BLM land and all these things that kind of make it complicated. What about Brazil? How does that work?
Well, so Cajueiro, we're in a fortuitous situation where we don't have any Indian reserves nearby. We don't have any forestry reserves nearby. The owners of the entire property package are farmers and ourselves. We own a small farm ourselves. And the way we work it is we do some sort of contract with the farmers, whereby if we upset their soya or maize, they get compensation for that. And we usually pay them some sort of rental. And, they also want us to find something. So, it's in their interests that we find something there.
So it's much quicker than you would see in kind of the global West, if you will. So Canada and the US, permitting is much quicker. It's much more streamlined, much simpler.
Yeah, for drilling and for trenching, it's pretty easy. As I say, the bulk sampling thing's taken us a while to get going, but we're getting close now to getting the environmental permit for that. The full environmental license for a project is always quite cumbersome, but we don't want to do that just yet anyway, because we're still opening up Pandora's box here. as we speak along the whole trend. And so we honestly believe in the next few months that as we add ounces to this people are going to start seeing that this isn't a small gold project. This is a gold district.
What would you guess the average timeline is to go from discovery to actually producing, pulling ounces out of the ground with permitting and building and everything, relating to the infrastructure in Brazil and everything else?
If you're doing it on a large project basis, probably 5 years, 4 to 5 years. And if you're doing it on a bulk sampling basis, we could be in production on a bulk sampling basis in the next 12 months.
5 years is extremely quickly, because why I'm asking this, because I recently read an article showing that the US had the second longest development timeline in the world at 29 years from discovery to production. So kind of...
Oh, well, if we take from discovery, I mean, when was Cachoeira discovered, I suppose, was the first the discovery drill hole in the central part of the property was probably in 2008. So, it's been a bit of a fit start. But don't forget, juniors have a tenuous lifeline. And it depends a little bit on the market, how much money they can raise and how much exploration. You made a very valid point. Most of our money goes into exploration. We're not, we don't have luxurious offices anywhere. I live on site, basically. We try to put our money into the ground. And so, if we'd done that as a major company, if a major company had moved into Cachoeira with unlimited funds, I think probably it could have been done in 15 years.
Yeah. I'll tell you what, Mike, if you built that 500 by 500 meter pool, maybe I'll come to live on site too.
Okay. Well, we'll fill it with water first, Antonio.
What about the overall socio-political and economic situation in Brazil, if you will? Well, we get some news here and there. There's something going on with Twitter, formerly Twitter, now X. But what's the current situation on the ground, and what impact does that have on your operations?
I often say to people there are two stumbling blocks in the mining world, right? One is the mining office, where if I go back to 2014 and what I alluded to why we were lucky early movers in the belt, in 2014, the bidding process for free ground was a technical bid. And so why we were such lucky punters, if you like, to get Apiacás, such a very important historic producing area, and Santa Helena, was because we were there when other people perhaps weren't interested in the belt. And we were able to win those two areas through the mining office. Now it's a monetary bid. And so juniors have less chance alongside a major of winning good areas in the belt. But it's all online, it's all transparent, it's all quick, and it's all easy to navigate, which wasn't the case 15 years ago. The environmental side of things is largely online, but it's a little bit slower than the mining side of things. So, you've got to be patient, and you've got to go through these things with the right consultants doing the correct work for you to get the permits on time.
Good. Well, Mike, it's been a good overview. I don't want to keep you all day. I know you almost have to go here, so I want to work toward closing it off here. But what am I forgetting to ask you? What did you come here hoping to talk about that I'm failing to bring up?
Well, no, I mean, we've got two other major projects in the portfolio. You said we've got 6. We've got Cachoeira, which is my opinion going to be a district, a gold district. It's the first gold porphyry district in Brazil. It's important in terms of the belt because we're starting to see various porphyries throughout the belt now. And lo and behold, 50 kilometers away to the east, we've got Apiacás, which could also be a porphyry district. And to the south of the belt, we've got Santa Helena, which, as you rightly said, is either going to be a series of copper veins or else it's a copper porphyry. And so drilling will tell us that. And whether we do that ourselves or whether we look for JV partners, the next 6 months will tell us.
You're right. Thank you for reminding me of talking about the other projects and just briefly, what else happens in between? I mean, you have the other 3 small projects. I mean, the vast majority of your land holding is made up by your three main projects. But what do you do with the smaller ones? What do you want for them? Do you want to sell them? Do you want a JV? What do you want to do?
Well, we've probably got a few 100,000 ounces of gold sitting in the other three small projects. We're open to offers there, but if you just look at other companies, you look at one of our shareholders, Aura Minerals, who has 11% of the company. They are putting operations into production, which are just a few 100,000 ounces of gold, and they're making a lot of money doing that. So I think in the short term, what we'll do is we'll look for somebody to take those into production.
So is that something you see as probable to happen over the next couple of months, where you find a suitor and you kind of monetize those assets in one way or another?
I see it will happen before mid next year.
Okay. Now that's an aggressive and a clear target, exactly how I like them. And that's it from me for today, though, Michael. Thank you for sitting down with me. Wish you luck on that journey. Hopefully, we're going to have a couple of more conversations in the future. And I appreciate your time, but I realize you might have actually important things to get to. So I'll let you drop off now, as I'll be moving on to the second CEO barbecue of today's Real Money Talks episode, for which I am going to have to travel to Nevada again, where I seem to be spending quite a lot of time recently, and maybe for a good reason too. And it makes sense, actually, given its name designated as the silver state and the state of the silver market. And it also makes sense. You see, you caught my, okay, whatever. And that's exactly what I'm doing today, though. I'm looking for silver, but luckily not alone, as I'll be joined by Andrew Pollard, the CEO of BlackRock Silver Corp, a silver exploration company listed as BRC on the TSX Ventures Exchange in Canada, where an average of about 470,000 shares trade each day. I also see a 52-week high of about 40 cents and a 52-week low of 19 cents. Now, the company just closed a $5 million private placement with Eric Sprott, so the share registry might look a little different by the time you're watching this. But the numbers that I could pull out were 272 million shares outstanding. And with today's $94 million market cap, that means BlackRock is trading at 35 cents per share, so close to that 52-week high. In addition to the 272 million shares outstanding, there are some options and warrants, bringing the number of fully diluted shares close to 315 million. But again, that would have changed by the addition of about 15 new million shares from Eric Sprott's financing. This financing puts Eric at just over 5% ownership, by the way, and prior to the financing, about 60% of the company was already in the hands of institutions and high net worth individuals, with management owning only about 4%, so a little less than that, I suppose, now after this financing. The last officially filed financial statement on Setter Plus, which shows me the numbers as of July 31st, 2024, and so I assume does not incorporate the addition of this $5 million from Eric Sprott, does show me about $11 million in current assets on it, most of which at the time, $10.5 million to be specific, was in cash and cash equivalents, with, of course, some prepaid expenses and some account receivables on top of that as well. Total liabilities sat at just under $1.5 million, most of which in current liabilities, so no long-term debt, and there's really just a small lease liability on the long-term side. And on the current side, about $1 million of account payables is what makes up most of the company's liabilities. In terms of operating expenses, the 9-month period that ended on July 31st this year costed BlackRock about $2.5 billion, which divided by 12 gives me a G&A of $280,000 per month. The largest element of that spent was consulting fees, director fees, management fees, all kind of combined, which represented about 51% of the total administrative spend. Again, combined though. About 11% of the money went into marketing and communication, and the remaining 40 or so percent is represented by various smaller expenses, including stuff like insurance, legal, offices, regulatory, filing fees, and stuff like that. As to exploration and evaluation costs, note 6 of the financial statement says that the 9-month period cost about $2 million, which is an average exploration expenditure of $220,000 per month over the last reported 9 months. The largest part of that spend, so about 64% of the money of the $2 million, went into drilling itself, with another 30 or so percent going into geology and consulting, with various other smaller expenses making up the rest. So in summary, we have 280 grand a month that's going into administrative costs and 220 that's going into the ground, for a total average monthly cost of about $500,000, leaving us with an exploration to administration ratio of about 0.8 to 1, meaning about 44% of the money went into the ground and about 56% went into administration. As always, though, please understand that this financial statement is nothing more than a snapshot in time. In this case, it is specifically at the end of July of this year, and it simply shows you what the finances looked like on that exact date and nothing more. Finances, though, are a fluid thing, and math is also hard if you're me, so I could be making mistakes in my reading of them. It is imperative that by the time you're watching this, you visit the company's website as well as setterplus.ca and look at the most up-to-date numbers yourself. Make sure you're getting the full picture. Now, for BlackRock, that picture, or that full picture, is fully focused on the Tonopah project in South Central Nevada within the Walker Lane Trend and within the historical Tonopah Silver District. BlackRock recently exercised an option to acquire 100% of this project, and so currently they control all of the 1,400 acres or 560 hectares of land, give or take. Just a quick word on the district here before I tell you more about the project, by the way, but this is a rather old, historically producing, high-grade, low-sulfidation epithermal district that was first discovered in the 1900s by a local who was called Jim Butler, who was a prospector, but he was a very angry prospector because one day, apparently, his mule ran off and he tried calling it back by throwing a rock at it, as one does apparently. But so that was a very heavy rock, and so he decided not to throw it and assay it instead, and that's what the legend says was the discovery of this district. It's up to you if you want to believe it or not, but it is an interesting story. Didn't take long for the Tonopah mining district to get officially organized, and by the early 1900s there were a few operational silver mines and a booming town sharing its name with the district. The district then became that important that it basically single-handedly saved Nevada's economy during the early 20th century. That was a very tough time. And so it also helped link Tonopah with the civilized world, if you will. And at its peak, the district produced up to 14 million ounces of silver per year, worth close to $500 million at today's spot prices. By the late 1920s, though, a lot of the highest grade and kind of easy stuff that was at surface had already been mined. The Great Depression had hit. Then World War II came along not too long after that, and most of the mines here closed rather quickly into it, with various smaller operations remaining into the 60s and the 70s, but nothing too big. So why even bother with it now? Well, that's a good question, and that's hopefully something I'll get to ask later on. But BlackRock has already found a bunch of silver, although it is underground, and the 2023 updated MRE shows about 100 million ounces of silver equivalent in the inferred category. The split, by the way, will depend on the prices of the metals at the time you're watching this, but at today's prices, this is close to a 50-50 split between gold and silver with, a little bit more of a gold bias, actually. The recently completed PEA on the Tonopah West project, though, was done at $22 silver and $1,850 gold, and it shows a production profile of 8.6 million ounces of silver equivalent for almost 8 years at about $12 AISC after a $170 million initial capex and resulting in an after-tax NPV of $326 million and an after-tax IRR of close to 40%. BlackRock, though, wants to find more gold and silver, and with a fully funded 20,000 meters in 50 drill holes program, they believe this resource expansion and conversion program might help them do exactly that. 40 of those holes, though, are, just to note, are expected to be infill drilling on about 25-meter centers, meant, of course, to convert some of that 100 million ounces of inferred silver equivalent that I told you about earlier into measured and indicated. The step-out or expansion drilling will thus be only 10 holes, and it's aimed at linking the DPB and NW, so Northwest Resource areas, together with all of this. So the infill and step-out drilling expected to be completed by December of this year. Here's the other curious part, though. The north part of Tonopah has come up with some lithium in the drill bit across a 7.2 square kilometer area. So what happens to that is also hopefully something I can get an answer on later on, but I'll try to keep it short here. Well, I think that train's kind of left the station. Sonova is not the only project in BlackRock's portfolio, though. Silver Cloud is the other one. It's based in the north, in the north of Nevada, but kind of north central Nevada. It's about 12,000 acres or 45 square kilometers. So it's not huge, but it is located on the northern Nevada Rift. So it is close, or it's actually adjacent to Hecla's Hollister mine. Been a while since BlackRock drilled it, though, but when they drilled it about 2 years ago, there was a narrow 1.5 meter intercept of 70 grams gold and 600 grams per ton silver in the core. So something might be cooking there as well. And hopefully I'll get to hear more about that from Andrew later on. But to actually get to listening, I might have to shut up. So I'll kick off the actual interview here with CEO Barbecue. Obligatory first question, Andrew. Who are you and why should I trust you with my money?
Well, that's an existential question I've yet to answer myself in terms of who am I. But listen, I came into BlackRock originally in 2019, not out of inspiration, but out of desperation. I was a shareholder in the company leading up to that for about a year and a half, putting a lot of money in, bringing a lot of my network in the mining industry in, and frankly, I was appalled at the performance of the old team. It was, from my perspective, it looked like a typical lifestyle company, a lot of money being spent and nothing actually being done. So, my background leading into this, I didn't just become an investor overnight. I've been working in the mining industry since I was 20 years old. I built the go-to executive search practice in the mining industry from the age of 20 till when I took over this company when I was I guess 34 years old. And, for about 14 years there, my business was predicated on one thing: management matters. So, I was working behind the scenes and in the boardrooms of new deals, turnaround stories, existing companies with retiring management. And, I built over that 14-year period a little black book of some of the highest caliber people in the industry, people which I made my living off putting into companies and helping them right the ship. So when I came into BlackRock, watching it for about a year and a half, just wither on the vine and sort of circling the gutter, I saw this not so much as a project level issue. I saw it as very much an issue that, let's see if what I've been doing for the last 14 years is bullshit or not. And let's see if I can come in and really just by making a few small changes at the top, reignite the company, give it a purpose, and move the project forward. And that's what we did. I joined May 2019. It was $1 million market cap and 3 cents was the bid. And that's if someone was daring enough to put the bid in. And within about 2 weeks, I just went about doing what I know best. Bakers bake, butchers butcher, and I built teams. So my first hire coming on, I was just going to join as an interim CEO. I certainly didn't think that we captured the sort of lightning in the bottle that we did, but I just went about building a team worthy of the company, worthy of the investors' attention. And my first hire was bringing on a guy by the name of Bill Howell. And Bill, he came on as executive chairman. I do all the market-related stuff so that I can leave him to do all the project stuff. And Bill was one hell of an acquisition. Bill used to be head of exploration for Placer Dome. All through the 90s, up until their takeout by Barrick in 2005 for $10 billion. Placer was known as like the technical exploration group. These guys were world renowned. The people reporting to him are the people running companies now and taking very prominent roles. And Bill was the top of that food chain. Lives in Nevada, found over 100 million ounces of gold in his career. And I got him involved because our Silver Cloud project, which was the original project for the company, the flagship, was actually a discovery of his that he made with Placer in the early 2000s. But it's greenfields, and in the early 2000s, the major mining companies had lost their budget. So, nearly 20 years later, I gave him the chance to, get handed the keys again. And, the rest is history. About, making some minor adjustments over the next few months, we started changing out the board members, and we built right now we've got $1 billion board. I brought on a major mining company explorationist to head up a micro cap company. 6 months after he joined, he brought us the Tonopah opportunity, which we're going to talk about. And, I guess 13 months after I joined, so we went from 3 cents to $1.60 on huge volume. And that was after our discovery hole at Tonopah West. And, it's been a wild ride along the way. Here we are 4 years later after putting out our first drill hole in Tonopah. We've advanced it to a PEA status. And as you mentioned, I mean, this is going to be one of the lowest cost silver miners in the world at 1196 all in, and it's going to have meaningful production. This project, if we can move it forward the way that the PEA outlines, will be the second largest silver producer in America. It's going to add 12 to 15% to America's domestic silver production. So, there's a lot more work to be done. We've created a lot of intrinsic value, and right now, I think we're at that perfect point where investors can see there's a real disparity between what we've got in the ground, the intrinsic value we've created, and how we're trading. And you mentioned Eric Sprott coming in. He came in the week after we just put out our last PEA, which established the project with these impressive credentials. And one thing I'll correct you on, you said he owned 5%. No, he owns 15% of us. He's the world's biggest silver bug, has put more money into us this year than any other silver company out there. And that last financing he did just a couple of weeks ago was done above market and no warrants, no half warrants, no nothing. So, he's making a big bet on us. And, I think he's going to be proven right in the not too distant future here.
You make a good point on Eric coming in and owning 50%, 15%, 1.5. And the main reason why I ask you that question about why should I trust you with my money is because I want to understand how much skin in the game you have, because it's easier for me to trust you with my money if you trust yourself with your own money. And so with BlackRock, insider ownership before the Eric Sprott financing was only about 4%, as I mentioned. And there also hasn't been much insider buying recently in the open market. So why is that? And is there a way for you or a plan for you to work on ramping that up and increasing the insider ownership here?
Well, listen, generally the companies where their insider ownership is huge is the companies where they've been giving founders rounds at 0.001% shares. This wasn't a new deal. When I came in, there was no seed stock. There was nothing. I came in as a pissed off shareholder. I hold about 5 million shares plus or minus. And all of those have either been bought in financings along with other market participants or in the market. This is my only focus. So I'm not diverting to, 5 different companies. I'm not collecting paychecks anywhere else. This is, my entire, with me, we're either going to find a way or make a way because I'm all in here. There hasn't been much insider buying this year because, we've got a very gracious government here in Canada that keeps changing the notion of what my fair share is. And as I'm not creating new deals or taking paychecks elsewhere, I'm all in. But you might see over the last couple of years, if you take a wider range look at that, I put $300,000 into the markets and into financings in 2023 and 2022. So I was, I'm a chef that eats his own cooking, and right now, frankly, I'm this. My analyst wants to get me to a mental institution in terms of how much of my actual livelihood depends on this going. But once again, I'm a chef that eats his own cooking, and I'm about as exposed to this as can possibly be. And I've ridden this all the way up. Listen, as I said, when I joined, we were 3 cents. A year later, we hit $1.60. How many shares did I sell? None. I see the big picture here. I'm more excited now about what we've got than I've been at any other point in my career because, we were overvalued based off just speculation on our first drill hole. We hit our all-time high on one drill hole. Along the way, we've been fighting the market ever since. When we hit that first discovery hole, that was right as the world was opening back after COVID. Silver had run from $12 to $30 in the span of like 3 months. And we put first drill hole out at the very peak there. And effectively, the GDXJ went down for like 2.5 straight years. We faced the most aggressive rate hike cycle in modern history on a percentage basis. Along the way, we were one of the most active explorationist groups in the world, certainly in the silver space in Nevada in 2021 and 2022. We did like 120,000 meters of drilling. So, I'm in it from Jump Street here, and I want to get either taken out or cash flowing. But either way, where we're at $100 million for what we've got, yeah, this is as good of a setup as I think we've ever seen. And the market's finally paying attention. We're up 40% since we put that PA out. And I think we got a lot of room to run relative to how my peers are trading.
What's your average cost of capital? Do you know that off the top of your head?
Oh, probably like 25 cents. I had a big shareholder. I bought a lot, when my first investment into the company before I took over, I put $100,000 in at 10 cents. That was before they really had anything, so to speak of. I put $100,000 in a couple of years ago into a 50-cent financing we did. So that obviously changed the cost base. And then along the way, I bought a lot in the market and exercise options and stuff. But I'd say my average cost base is somewhere in the mid to high 20s.
Okay. Given that you didn't put the company together at first, I don't assume you own any royalties in the project yourself to your
No,
personal name or anything like that.
no. This is Tonopah was a consolidation that, didn't even make itself known until really COVID was emerging. The world was shutting down, and it was a David versus Goliath acquisition for us because there was lots of mid-tier companies that were in the bidding, but they couldn't get down to site and they couldn't make decisions quick enough. And then do you remember what happened between, say, February and April of 2020?
Mm.
The markets just went into meltdown mode, and we scrounged all the cash we could to sign this option deal. Our first payment was $250,000. Our first drill hole cost about the same. And on the back of that, we added about $100 million in market value on that first drill hole because it was a proof of concept. And that proof of concept was, these old timers didn't stop mining in this district because they ran out of gold and silver. They ran out of district. They stopped mining because of some technical issues of the day and the Great Depression. And we've proven that theory, right. We've drilled out 4 kilometers of strike. This district, you touched on the history, but this time 100 years ago, this was known as one of the richest places on earth. Its place in history, not only in Nevada, but it's almost like Forrest Gump in the different touches with history it's had along the way. When it was, in 1906, when San Francisco burnt down because of the Great Fire, the riches coming from Tonopah helped rebuild San Francisco. In the 1920s, after London had been bombed out during World War I, the silver from Tonopah was it was sold to the Bank of England. It was called the peace dollar. It helped backstop the currency of London, and all of that silver came from Tonopah, and that helped, just backstop their currency. I mean, there's a lot going on there, but this opportunity, when we first got our hands on it, the mid-tiers who were vying for it, they knew the potential, but most market participants didn't believe us. They thought it was too good to be true, which is why once we hit, our first drill hole hit 30 meters of a kilogram per ton silver equivalent. That's why the valuation moved up so aggressively. And here we are 4 years later. This is going to be a big time producer. So, it's been a wild ride, but this is very much a deal that was generated not by people first, and that's the focus I took in coming in here and building a company. Companies are generally built around a project, or afterthoughts are given to team building. But with me, I wanted to bring out the heavy hitters, and that was the narrative early on. I'm going to open up my little black book and see what we can do. And you take that team-based, people-based approach, you give it 6 months, you let it cook a little, and boom, this is one of the only silver discoveries of the last decade, easily the highest grade one amongst my developer peers right now. By our next closest high grade peers, 55%, we're 55% higher head grade than our next closest high grade story in the industry. So, the train's leaving the station, and now we're trying to get the market back with a heavy duty drill program, the first one in years.
I want to talk about that last part where you talk about the valuations, because when I met you at the Precious Metal Summit in Beaver Creek, you showed me a slide where you had the value. It's a valuation slide essentially. Though it's an EV to ounces in the ground, which is not a metric I have a lot of respect with. I still kind of had the idea of, okay, you compare yourself to these people, to these companies that are that have outperformed you? And also when you compare share prices with some of these names like Vizsla or Dolly Varden over the last 52 weeks, your stock, although up, has lagged them over the last 52 weeks again. So what do you think that's due? Why are you not getting the valuation that you think you deserve?
Right. Well, I see that coming back in a big way. What I do know is that when we've been drilling in the past, because of the grades, we've always been one of the top performers in the industry. We've always commanded either number one or number two highest EV to ounce in the ground ratio. But we stopped drilling in mid 2022, maybe early. I think our last drill hole was at the end of 2022. So we took our foot off the gas pedal there simply because the rate cuts were coming in, the tides were going out, drill results weren't getting respected in the market anymore, and I didn't like my valuation. But we went, when we started drilling this project in 2020, it was June of 2020, we only set out to do 12 drill holes. And when we got a call from Eric Sprott the next day, and we did a $7.5 million financing. And then we never stopped drilling for about 3 straight years. We did something like 150,000 meters all in when you include all the drilling we did to the northwest there too, in that 3-year time period. And we moved so quickly, and we captured a lot of attention because it's easy to capture attention when you're putting out constant news releases and drill results and all that. When we took our foot off the gas pedal last year, it was because we were drinking from a fire hose in terms of all the data. And when it's coming at you that quickly, it's hard to just sort of make sense of everything. You're always focused on moving the rigs, or you're not really getting an understanding of how all these random intercepts in space relate to each other. So what did we do last year? We put our head down. We took all the drilling we did post our maiden resource, which left us with 42 million ounces in maybe 2022. And we decided to incorporate that, take a step back, try and see the forest for the trees. And we put out a resource last year at the end of October, which 2.5x our ounces. We went from 42 to just over 100 million. We increased the grade. We showed a straightforward path to adding substantial more upside, just given the way we drilled it out, with these big gaps along a vein corridor, bookended with mineralization on either end. But we didn't have anything to follow it up in terms of, you need a reason to keep people's attention. And we didn't have money to do the drilling. What we wanted to do is, we're a very earnest group. We've put out 3 technical reports in 4 years from our discovery. There's not a discovery in the industry, a vein hosted one, that has moved from discovery hole with 0 drill holes in a database to a PEA as quickly or cheaply as we have. So we show our work every year. And what we decided to do once we had that resource out was take a look at, drilling out ounces is all well and good, but you want to see how that relates to becoming an actual mine. You need to know what kind of mine you're going to be, what sort of an operation, where are you going to go first where's the decline going? Where's this? Where's that? So, you mentioned our financials, from the trailing 9 months. Well, what have we been doing the last 9 months? We weren't drilling. What we were doing was we were getting engineers involved. We were getting outside consultants involved on how this will be permitted. We were getting people looking at water and hydrology and all of that. And, over those 9 months, what were we doing in the background? Well, we were putting this PEA out. What is this PEA? Gives us a mine plan to work out of. And that mine plan is actually informing the drilling that we just started on at the end of July. We're not just converting to M&I random ounces throughout the property. No, we know that there's a 2.3-year payback as outlined in this PEA. Well, guess what we're focused on converting now? We're focused on de-risking through those early years of production, converting those ounces first based off of that mine plan. By taking the time to let the project actually develop, so you can get a methodical understanding of how this is going to grow, how you develop it, that makes the drilling less random. That makes it targeted. So that's the focus this year. We've got 40 drill holes, de-risking our ounces through the production period. It's going to be a no-brainer. What do we know in the early years? Well, that PEA outlines that this is and what we're drilling into right now, this should be the highest head grade structure in the industry when all is said and done. Our PEA outlines that in our early years of production, we'll be mining a stope that's going to be roughly a kilogram per ton silver equivalent. There's nothing like that in the industry. So we're drilling that out, and we're going to be, our first drill holes in 2 years are going to be focused on the highest grade structure, tightening that up. And then we've got a lot of upside that we're focused on now too, because we see, our mine plan shuts off right at the corner of the DPB area. And we actually orphaned a 12 million ounce deposit from the PEA that is part of our resource that's a kilometer away along the same vein corridor. Well, guess what? I'm not focused right now just on adding random ounces. We're focused now on adding mine life. I think we can take this 8-year mine life, which granted might seem small depending on, irrespective of how high margin these ounces are going to be in the context of just the cash flow you're looking at. But we think we can add another 3 to 4 years of mine life, literally increasing our mine life by 50%, while the capex will stay exactly the same. So this is going to be a fun year on the drills looking for us, but we had to take that time off, to take that foot off the gas pedal, to let the engineers in, to develop a plan so that our conversion program, people will follow that in real time. The upside, they'll be able to know that it's not just random ounces, but it's mine life you're adding. And after 2 years out of the spotlight, this PEA is a palate cleanser for the market. This PEA is a rallying call for every analyst that doesn't cover us now. They have to cover us. There's not that many development stage projects in the world, and most don't have the economic profile that ours will have. So, we put this out, the PEA out, a week before Beaver Creek, and what happened? The big banks analysts started calling. We did a site visit right after Beaver Creek with a handful of analysts as well that don't cover us, that now sort of have to, just because we've made their job very easy. So after being out of the spotlight for a long time, we're ready to take center stage again, and we've got about 50 drill holes will be completed between now and the end of the year. And with the squat financing, we're going to keep the pedal up to the metal, adding more mine life next year too.
What's your target for expansion here, by the way, with this drill program? Like when you move the resource from inferred into measured and indicated, what's your internal goal for the size of the project? How big do you think it's going to get?
Well, we think, if we can drill, if we're successful on drilling out this 1 kilometer, I'll put it this way, an easy paint by numbers reference point for a project is from the last operating mine in the district, which is right where a property starts. It's a vein corridor. It sort of moves east to west, but it's got some, northerly trend to it as well. We've drilled out, as the crow flies, 4 kilometers of strike on this one cohesive, intact vein corridor, the same vein corridor which they've produced 200 million ounces of silver and 2 million ounces of gold in 30 years. Now, internal to that 4 kilometers, we've got 3 different areas we've drilled out. If you take those three different areas, that equates to 2.5 kilometers of strike. Internal to that, I've got 1 kilometer gap. We think that alone, that 1 kilometer along maybe five different veins, will add another 30 to 50 million ounces just there. And you can't get more straightforward drilling than that, because we've got the deposit here and we've got the deposit here. We stepped out in 2022 1 kilometer along this vein system and hit this northwest step out deposit, as we call it. We don't have 3 different deposits when all is said and done. We've got one big mine. So on this round of drilling, if we can get enough drill density into this kilometer trend, that's going to be another 30 to 50%. Not only that will bridge the gap to that 12 million ounces that we omitted from the last mine plan. Now, when you factor in dilution into all of that, you're probably looking at maybe 4 to 5 years more of mine life. And once again, I'm not expecting our capex to change all that much. Maybe it'll move up with inflation ever so slightly, but we're happy with our 1,500 ton per day mill. Our cost to go underground isn't going to change. I don't think the early years of our mining plan are going to change, but if we can just add more mine life, just expanding onto the drilling easy mine expansion style ounces onto the same one development, that's going to blow out the economics on our next PEA, which we're hoping to have sort of be in that position towards the end of next year. It'll blow out our ounces too, but once again, I'm not interested in ounces. I'm interested in how this plays out in terms of a mining operation. And between this year and next year, we're all, right now at $1,900 gold and $23 silver, we're at a 2-to-1 MPV to capex. If we can bring on 4 or 5 more years of mine life, that's going to change wildly. But we've got a very, very clear path now. It's easy to understand, and there's a lot more life that this district's got to give.
Well, within the framework of thinking about this as a potential mine, vein narrowness and continuity is always top of mind for me when looking at projects in Nevada. And the veins in the current resource average 4.2 meters in thickness, which isn't all that thick, especially considering sometimes they can be only a few centimeters thick because they pinch and swell. So what's your internal expectation for the size of this veins on this drilling? And is there a point on your land package where you expect veins to be swelling more, or where you can add on more ounces?
Veins always pinch and swell. What's nice about a PEA, you can there's about 20 different ways to hide the ball in terms of how resources are presented, for example, but there's no hiding PEAs. Our PEA, everything in there, it fits within a stope, right? It has to fit within a mining scenario. So our project itself, 4.1 meters, okay, that's at the grade we've got is plenty. The smallest piece of mining equipment you can get underground is about 1.4 meters. So for all of our resources along the way, we got penalized for this because a lot of our peers don't constrain them the way we constrain them. We only model down to 1.5 meters thickness, because if you're modeling any less than that, well, that's a good way to jack up your average grade. But if the smallest piece of mining equipment is 1.5 meters and you're modeling to 0.5 meter thickness, that's smoke and mirrors. There's going to be a whole bunch of excess dilution in there. With ours, 1.5 meters, and all of our resources going into this PEA were block diluted grade. Now, none of our other high-grade peers present that way. So we factor in dilution into every one of our resources, whereas our others don't. So if you look at that slide in my slide deck, it shows the enterprise value ounce in the ground valuations, and we've separated it out by grade amongst every large silver rich project in the world. Now that's based off of how the grades are presented in the resources. But if we factored in dilution into our resources, but our peers haven't, well, it sort of looks like we're neck and neck with the other two high grade stores you mentioned in terms of how the resources are. But when you look at the head grade you're mining, once you get to the PEA, that's where you can find out where the Emperor has closed and where it doesn't. Our head grade is 570. Whereas it looks like we're even with our next closest peer in terms of resource grade, that's not true. They have to factor that dilution into their mine plan in terms of what they're recovering, in terms of their head grade. Well, if they factor in that dilution down line and at the point where they're putting out a PEA, all of a sudden what looks like similar grade stories change markedly. Our next, we're 55 to 60% higher head grade, what you're actually mining, than our next closest peer, despite how our resources are presented. So in terms of mineability, yeah, well, that's all taken into account into our PEA. Our project's perfectly amenable to conventional underground mining methods. So it's about 75% long hole stoping, which is nice and cheap, actually. And then the rest, the other 25% is cut and fill. And that's also very straightforward, very conventional. And it provides us the added bonus of being able to re-inject some of our dry stack tailings underground for rock stability. So it's a nice, straightforward operation that we're envisioning. In terms of the expansion drilling we're doing right now, I mean, that's why we drill. All I know is that this is a system. This is a vein corridor that 100 years ago was one of the richest places on Earth. And it's the same veins they were mining. We're just stepping out along that extension. So we'll drill. Ask me in 4 months, but I think we'll never have an opportunity to add more ounces quicker and cheaper than we've got over the next 12-month period. I'll put it that way. Like, it's predictive style drilling.
The Tonopah district is also heavily faulted. So to your point of it being predictive, that faulting could add to the structural complexity, but it could also offset some of the veins, which again tend to pitch and swell. And so that makes chasing the veins more challenging. So how are you dealing with that? Do you have any structural geological techniques to understand these offsets and locate potentially displaced portions of those veins?
Yeah, well, we found the offset. You're correct. There's a lot of geological activity going on down there. I mean, that's what makes this district so so unique. Tonopah historically, it's second to only the Comstock lode in terms of silver production, but in terms of silver gold ratio, what they pulled out at Tonopah and what we drill, like what we see in the drilling, it's 100-to-1 silver gold ratio. There's nothing like it. This is the reason why Nevada to this day is known as the silver state. It's the queen of the silver camps. The king would have been the Comstock, but this is way more silver heavy than anything else down there. Now, what we found early on, the old timers thought that it was just simply an east-west trending vein corridor. They made the discovery, as you mentioned, Jim Butler, his mules ran off to this big outcrop on the east side of the district, which is where the town of Tonopah is today. And they started mining these super gene enriched veins right from surface. And the old timers did no drilling back in the day. They followed the veins along strike, underground. If they lost a vein, if there was a fault, they drift across until they found it, and then they keep mining again. So all of that historic production started on the east side of town, and it went to our side, and it looked pretty straightforward, just east to west. Going into that, obviously, the understanding of geologic and structural controls and all that developed a lot, especially with epithermal districts since our mine shut down in the mid-1920s. And what we figured out early on is it's not truly an east-west vein corridor. The mineralization is following along the inner edge of a caldera margin. So, picture a blow off top of a volcano, just like my coffee cup. The veins want to just follow the edge of that internal of the caldera margin, and we had that insight early on. So what happens is, it's the last vein was here. We were able to get a lot of drilling into it early on, but we couldn't really piece together things on an east-west basis. And then we realized the caldera started swinging up to the northwest. And all of a sudden, in 2021, 2022, when we realized that the orientation is going to go from this to this, we stepped out 1 kilometer and we hit it up there. Now, we've got a good handle. We've got drilling on all sides of where the faulting is. We've got a good understanding of that. So yeah, there are definitely areas where things are offset, but that's all taken into account at this point. And really that caldera theory is fantastic for us because we've got, one of the nicest things about our project, Nevada is a good place to be in the mining industry, but private land in Nevada, which our entire operation is situated on, means that there's no federal government involvement in our permitting process whatsoever. So what might take something 5 to 10 years in Nevada to permit if it's on BLM land or federal land. With us, once we get to the point where our baseline surveys have been done, our water, our air quality, and a final, engineering design is submitted, you're looking at 12 to 14 months. So what's nice is our patent claim block goes up to the northwest and we can follow. We've got this drilling we're doing right now, we're doing a couple step outs because the system's still open to the northwest, but it's going to keep going. We've got once again, our understanding of this district has emerged rapidly since we started just 4 years ago.
Are there still parts on your land package where you can find mineralization closer to surface? Again, given historical workings, probably, already looked at a lot of this ground, or how deep do you think those holes are going to be, specifically the 10 holes that you're doing on step-out drilling?
Yeah, our step-out drilling is what we find is that right along the edge, the inner edge of the caldera, is where the highest grade structures are, and it's where they tend to be the shallowest. So we're definitely following up on near surface mineralization as we speak. That's not part of it is resource expansion drilling. It's outside of the shell, but that's actually outside of our shell in the early years of production to the southern edge of our DPB where the decline's going to go first. Our highest grade intercept of the project came at the end of 2022 where we hit, I think it was 6.5 kilos over 1.5 meters or so. And that was around 200 meters. The payload top to bottom at Tonopah, it's at least 400 meters top to bottom. Our Victor mine, which is at the very northeastern side of our land package, that was the last commercially operating mine in the district. And the old timers mined that down to around 1,880 feet before they flooded out the mine. and had to shut things down. But where they stopped mining there, the vein kept blowing out and blowing out as they went deeper and deeper. But so this is a project that's going to grow in 3 dimensions, not just along strike, but if we can get underground and keep drilling at depth, it's going to be there's going to be ounces out of there. In terms of the near surface stuff, we've got 40 drill holes de-risking through our initial payback period. So we want to de-risk through the first like 3 years or so of production. But if we can also get our capex down, or at least lower the cost it'll take to start mining by drilling near surface, then outlined in this PEA, that's going to cut down the cost and blow out the economics as well. So we're chasing mineralization near surface as we speak. In fact, some of our first drill holes that I think we're going to be releasing in the imminent future are targeting the shallowest portions of our property where there's no mineralization to date has been reported.
Well, speaking of historic workings, part of the historic production on this project was also underground, so it was not only surface work, if I remember correctly. Could that be a risk for your exploration efforts, as in encountering underground cavities or something like that while drilling and causing loss of core?
So no, it's challenging to drill. You know, Victor, for example, that was the last mine in the district, and that's, you know, to drill that out to get to where we've been, we've had to navigate across 5 different levels of workings. Like if you bottom your drill hole in a working, you lose it. But this is true. You know, the company that consolidated this land package and was like, it was a big time mining company in the 1910s and 20s. It was called the Tonopah Extension Mining Company, and they named that company very correctly, because that company effectively went into Chapter 11 at the start of the Great Depression. It went into Chapter 11 because they flooded out their mine in the mid to late 1920s, and took out a bunch of debt to fund some heavy duty diesel generators and some water pumps to be built and shipped from Europe. By the time they were shipped over, it took a couple of years. They'd stopped mining, they installed them. The Great Depression happened, silver just tanked, and they couldn't pay back that note, and the company went into Chapter 11. We're literally picking up from that extension. There was no mining beyond where they left off on that northeastern portion there. So it's literally, you know, we're able to piggyback off some cost savings for the PEA. You know, we're able to open up some of the old historic shafts and use those for ventilation and things like that. And certainly having those workings there, that was the original map that we used to target our early drilling. We didn't do any geophysics. There's nothing at surface. We figured out a good place to start from would be where they finished off from. And now we are. So the vast majority of our project is virgin territory. It's completely, we're not remnant miners here. We're not focused on just like reopening old mines. No, we've got 4 kilometers of strike beyond where that last mining was. So it's sort of the best of both worlds.
And you also have the water rights to complete this round of drilling and everything. Like that's not, you don't think that's going to be a challenge, or how does that work for you on private land
we're in
in
the
Nevada?
process of establishing or affirming our water rights right now. You know, these are patented claims, and really, you know, our discussions with the state are that all we have to do is show that the old timers used the water for processing at their projects, and then effectively we'd be affirmed those rights now. You know, there's no shortage of water in Nevada, but water rights are scarce. If you know, we think we'll have no issues effectively pumping out the water, especially from our Victor area, and re-infiltrating that, using that for a processing facility. So it's a really closed loop system we've got here. And I think, you know, we're making headway there. So I think that's one of the better things about the project, is that we think that the water rights are ours, and that's just a matter of just going through the historic records and showing it. They did. I mean, there was old stamp mills on our property which were using the water. In fact, the water from Victor that was being pumped out in the 1920s, they actually had a neighborhood swimming pool, which was actually just the pumped out mine water, and it was warm and kids and stuff would swim in it. I guess that was before they knew about heavy metals and all of that, but we think we're on the right track there.
What other permits do you need to move forward? Is it only the water, or what does that look like?
Yeah, well, you do water quality, you do air, you need rock stability, so, you know, geotechnical drilling. That's all stuff that we're using this PEA effectively. This PEA is done in pencil, not in pen. I mean, I think the next year or so is going to be meaningful. We're going to, I see the center of gravity not being necessarily where it is now, but actually moving up to the northwest. So that may, the location of where we put our dry stack tailings, for example, may change as things keep moving to the northwest. I think our decline will most likely stay in the same place because that's the shallowest portion of our property and the highest grade structure we've got, but that may also change. I mean, we may hit some things we're not expecting. We might tap into a near surface chute on this kilometer of strike we're drilling out now. So, but what this PEA does is it allows us to use that as a roadmap for all the other test work, all the air quality, all the water. We're doing geotechnical drilling as part of this rock stability characterization, all of that, so that by the time we're ready to submit a more finalized engineering plan, a finalized mine plan, we'll have those, year or two worth of benchmarking on the water and air side that it'll just be presented with, a nice little bow. And from there, once that submission is made to the state and county, it's about a 12 to 14 month process after that. So we'll have, if a mid-tier were to come in and buy us today and money wasn't an issue for them, you could be producing in about 40 months here, start to finish. So our Lassonde curve isn't a typical Lassonde curve where you're in permitting purgatory. It doesn't matter if Harris wins or Trump wins. Federal government has no say. Nevada is the only state in America that has their own EPA. So very constrained Lassonde curve on the development side. And even though we've got a PEA, the amount of ounces in mine life that we think we'll be able to add in the next 12 months is going to be unlike anything we've had before it. So.
Is the local community or everyone that has a potential claim to your ground or something like that, is everyone happy? You don't have to get any special agreements in place for anything else?
The town of Tonopah is there because of the original silver and gold discoveries, right? In terms of what's nice about ours is ours will be a very small footprint, high octane underground system. You're not going to see much in the way of surface development. And where we are, we're about 2 kilometers. I guess our mine decline would be about 4 kilometers away from the town. And the town is sort of cut off by this mountain called Brower Mountain. So like all of our entrance, our operations are going to be behind that. So cut off from the town. And then the other benefit they have is like we're close enough to the town that you get all of the benefits of having that infrastructure there. There's power, there's water, there's roads. US Highway 95 that cuts from Las Vegas to Reno cuts right across our property. So really the only thing at surface on us are some, there's a Burger King, like it's right along the highway there, but we control 100% of the mineral rights and then probably 95% of the surface rights. And if you look at a satellite picture of our map, and there's lots of them in our slide deck, like there's nothing else there and it's flat and it's easy. So it's the best of both worlds. Like Tonopah, like Esmeralda and Nye County in Nevada are like the two most gung-ho mine counties in Nevada. And to put it this way from a permitting perspective, directly south of us, directly abutting our project, are BLM claims. Those BLM claims have the Three Hills deposit and the Hasbrook deposit. Hasbrook and Three Hills is going to be a bulk tonnage heap leach mine. They've got federal government permits in hand. That's a shovel-ready project, and that was federal oversight, not local. Ours is just local. So if a bulk tonnage heap leach operation can be permitted and be ready to go, ours on private land, small footprint, and a huge boost to the local economy is going to be as straightforward as it gets.
Good. Well, Andrew, I didn't get to ask you all the questions that I wanted to, so maybe next time we'll book some more time to go through some of these things, because I also wanted to talk about the Silver Cloud project and the lithium stuff that you've been coming up with. But we have to work towards wrapping it up here in a couple of minutes. What's very important right now? What am I forgetting to ask you? What do you think we should cover here at the end?
Well, listen, it's always nice to talk about other projects, but on an intrinsic value, just on Tonopah West, we're undervalued based off of every peer comp you want to look at. But the market's waking up. Like we moved 40% last month. We did 2.5x the volume last month than we did in August. We had an endorsement from Eric Sprott. who's written $10 million worth of checks into us just since June. And this last deal he did was above market and no warrants. There's still a mismatch between what we've got. I don't like enterprise value, ounce in the ground metrics much, but they do sort of show how the market values the economic potential of our ounces. And after last year, when we put out our last resource and we 2.5x our ounces and got 100 million, and we fell like a rock because I didn't 2.5x our stock price after that. It showed to me that the market valued my ounces as being more marginal compared to the other high grade stories. Now, I knew the market, that's an understanding gap, and that's what we set out to prove with the PEA. The PEA shows these are going to be some of the highest potential, highest margin ounces in the industry. And we're not in Mexico, we're not in Argentina or Bolivia or Russia. Private land in Nevada, 55 to 60% higher grade than our next closest peer comp, with a clear path to add ounces. So after 2 years of not drilling, we'll file our PEA within the next couple of weeks, and that will be a great jumping off point for not just retail, but the analysts as well and the corporates. And from there, follow in real time the most active program we've had in 2 years, de-risking the project and adding mine life.
Good. And that's Andrew Pollard. Sir, thank you so much for investing your time in me, and hopefully speak soon.
Thank you.